demand is starting to slow. We're seeing that way back in the supply chain.
The real question is, are investors pricing in growth opportunities over the next 5 years?
This has been a very slow-moving economy and market. If you have super high conviction right now, you're not paying attention.
What we've seen so far seems more consistent with a soft landing in the labor market.
We still think we're going to be in recession by the end of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Welcome to Wall Street, where a month feels like a year. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. As we close out May and kick off June, your equity market just about positive by 0.2%. Shout out to Jim Reed at Deutsche Bank this morning. Really enjoyed that note. TK reminding us that First Republic was taken out by JP Morgan in May. I'd totally forgotten that.
Yes.
That felt like months and months and months ago, TK.
We had a couple comments yesterday that it's not over. I mean, I thought Bob Michael yesterday of JP Morgan was just riveting in his view on this, and that the deposit dynamics are still there, and that's a huge story for June and frankly into the summer. We've got to remind ourselves, June 1, and it's simple. There's a wall of economic data today. John, you love the ISMs, and we've got an early jobs Friday tomorrow.
Yesterday, whipsawed three different ways. We had the Chicago PMI, ugly, okay, deal with that. JOLTS data, job openings, surging, had to deal with that. And then Fed speakers came out. Whatever you do, don't call it a pause. It upsets them. It's a skip, Brammer. It's a skip.
Okay, so this sort of whipsawing action, I couldn't get my head around. The JOLTS data, I thought, okay, well, this shows a hot labor market. The ISM, okay, yeah, we've got a manufacturing recession that's not great. And then Fed officials come out, and what does data dependency mean? And I know that you've been on this all year long, but basically the data doesn't matter. If we get a really hot jobs report tomorrow, do we really get a difference, or are they going to do a pause, skip, whatever you want to call it, this month?
What did Governor Jefferson say yesterday? Something like, if we do pause, we mean skip. And that skip would mean that we could hike again. But it doesn't necessarily mean that it's a peak rate of the Federal Reserve. Do you think the market's going to see it that way?
It's what the market is actually saying this morning. Right now, what you are seeing baked into the Fed futures markets are basically there's going to be no hike this month, and then there's going to be a 25 basis point hike in July, and then it will be cuts later in the year.
Barclays say hike in June still. Data's going to push them over the line. Citi, Andrew Hollenhorst talked a lot about Andrew. He thinks hike again in 2 weeks, and then hike again in July.
I'm way more interested in China. I thought yesterday's China dynamic was far more important.
Well, thanks for listening to us, but carry on, please.
I don't agree with any of this Fed parlor stuff.
Oh, okay.
I think it's just a
Value
modern
add.
invention
Wonderful.
of the futures market, and the answer is skip, pause. What's Beijing going to do? Are they going to skip or pause here with an imploding economy? Zero Hedge featured Bloomberg's George Lee of our markets team in their summary of all the research and guesstimates on China. Guess what? Jobs report Friday. China opens Sunday evening, New York time.
They can't reopen twice, can they? That's the problem. Where's the growth engine going to come from?
Yeah.
Where's the challenge to the dollar strength we've seen over the last few weeks going to come from?
And then what does that mean for Europe? I mean, honestly, these are all of the stories that have been hard to get a handle on. And I've got to say, going back to where you began, this idea that a month feels like a year. Think of all of the narratives that we've gone through each week. And here we are halfway through at an inflection point, maybe, with the Fed showing that clearly the risks right now are to the downside, and they're aware of that. So again, we have to wonder, what are they looking for to give them a sense that they should be hiking rates?
The last 3 minutes felt like a year. Let's get to the price action. Equity futures on the S&P 500 positive by 0.2%. China in the bond market yields higher by 3 basis points, 367.52. Why do you never listen to us, TK?
I don't believe. I think the media parlor game and all the Fed speak. It's not that it's a waste of time. It's just complete slave to the data. The most important data, I guess, is the wall of data today. ADP, does it matter? I don't think so. Claims. And then, of course, tomorrow's data onto the inflation data is far more important.
Is that why you stopped reading the Fed speeches?
Some and several of us have stopped reading it.
You can tell. Bramo?
Okay, we're talking about the data dump. Let's just give a sense of what we are expecting. Jobless claims at 8:30 a.m. Very interesting to see whether they do continue to tick up, especially after the JOLTS data yesterday. ISM manufacturing PMIs at 10 a.m. I'm very curious to see whether that reflects the Dallas Fed data yesterday. We also are hearing from Philly Fed President Patrick Harker, which will be interesting to see at 1 p.m. whether he sort of double downs on the skip, pause, whatever you want to call it, this month. Today, we have banking executives speaking at the Bernstein Annual Strategic Decisions Intelligence Conference. This will be interesting, especially in light of the acquisition that we've all forgotten about, First Republic. We hear from John Waldron of Goldman Sachs, Bill Demchak of PNC, which actually might be the most interesting to me, simply because of the regional banking issues, and Brian Moynihan of Bank of America. And today, retail earnings before the bell: Macys, Land's End, Dollar General. Very curious to see, particularly the lower end, and Lululemon after the market. I like Lululemon.
I know. There's nothing wrong with that.
I know.
I can make it sound like it's a secret that you can't talk about.
I mean, I don't know. Like, I'm just explaining that I like the casual trend, and I know it's on its way out, and I am curious to see whether that's reflected in the earnings.
Is it on its way out?
I don't know. I mean, that's what I hear from different people.
I'm trying to push it out of Midtown.
I know. You've been on a single-handed crusade to get rid of it.
Sell in May and go away. SPX flat.
You really aren't listening to us, are you?
-4. NASDAQ, as you mentioned yesterday.
Up 8%.
Up 8%. 500 basis point up over equally weighted NASDAQ.
Any comments
I have
on
never
Lulu?
Seen that. No comments on
Okay.
that.
Russ Kostrick
I've never
joins us
been
now.
in a Lulu.
BlackRock Global Allocation Fund Portfolio Manager.
Maybe I should.
Russ, the scores are in. Tom mentioned them. The S&P 500, marginal gains for the month of May. The Nasdaq still absolutely flying. You've been very clear every time we've caught up, consistently adding equity risk. Now, Russ, can you tell us where you've been adding that risk?
Absolutely. Good morning. So, Jonathan, I think as you might remember, we were underweight in the fund for really most of 22. Thankfully, that proved to be the right thing. We've been adding back, and the thesis is fairly simple. The economy has proven remarkably resilient. We've spoken about the reasons: the labor market, excess consumer spending. And the reality is, as we saw as we had the Q1 earnings results, corporate America is actually doing all right. And in an environment in which nominal GDP is likely to hold up a lot better than many of us thought 6 months ago, we think there's still an opportunity to add back on weakness. What we've been focusing on is what I'd call stable growth, high quality growth. In other words, we're not looking at the unprofitable companies that were ripping in late 2020. We're looking at companies that can generate earnings consistency, margin consistency, low leverage, that are very profitable. Right. And that's where we've really been focusing the ad so far this year.
Are there a lot of those companies out there? I mean, I know you got a fancy computer screen. Maybe you're doing it off your iPhone. But, Russell, there are a lot of companies out there that give you that quality free cash flow growth.
There are actually. Clearly the market has been focused on one thing for the last few months, and that's been tech and parts of tech that are most levered to AI. And there are a lot of themes there that actually we like long term, but there are other parts of the market. It's not simply tech that evidence these characteristics. You can talk about defense companies, luxury good manufacturers, parts and industrials. So we are finding that there are a lot of companies, many of them US-based, that are giving you that quality cash flow that's likely to hold up, even if we do see some slowing in the back half of the year, which is, let's be honest, the most likely scenario.
My favorite part about your note, Russ, is that it sounds risk on, right? This idea we've been consistently adding to equity risk. Okay, so you're bullish, you see opportunity, and then you go on to read the rest of it. The economy is decelerating. We expect there to be an increase in defaults. We're going to have issues. Perhaps recession's not a foregone conclusion. But at this point, is there sort of an interesting conclusion here that in some ways equity risk in some of these companies, with all of the caveats, is a safer bet than certain slices of the bond market?
I think that's a really good way of putting it. And just to be clear, we've been adding equity risk back, but we were adding it from a very underweight position last year. So it's not a back up the truck moment, but it is a moment to have that exposure. And I think the point you made is a very good one. You think about what is done well in this environment where you've had a mini banking crisis. You've had concerns about the debt ceiling. The companies that people have faith in that are going to produce solid earnings regardless of those outcomes. And again, if you have a drawdown of the market, you're going to see these names take a hit. But long term, 6, 12, 18 months out, I think these are places not so much to hide, but to weather what is likely to be a slowdown and what is still likely to be, an environment where there's some uncertainty around how far the Fed is going to go.
And we were talking about this yesterday, about whether bonds will still provide the offset, or actually in some ways, if some of these cash flow stocks are kind of the new offset at a moment where 60-40 doesn't necessarily have the same automatic dependency.
Yeah. Well, 64, I don't think 60-40 is quite as dead as everyone made out to be last year. And there have been periods this year where that bond worked very well as a hedge. In the aftermath of SVB, that stock bond correlation, after being very positive in 2022, flipped back to negative. Having said that, I do agree that it's going to be a little bit more varied. In other words, if we get the bad inflation print, if the Fed is going to talk about going further, you're going to see that stock bond correlation flip more than it did for most of the last 10 years. So it's really a matter of both. Having some good high quality carry in the portfolio and having these companies that evidence quality. Now, all the debate about growth and value, this is the attribute we think is most important in a portfolio right now.
Russ, you just seem like you're in the zone right now and things are going right. I'm just reading this note. We have also added a small gold position as a tail hedge. Even your hedges are working with equities flying. What's the gold position about, Russ?
The gold position is always a tough one. And, we've had gold back in 2020. We took it out last year when the dollar and real rates are ripping. The gold does a couple of things. One, in an environment, if we start to see in the back half of the year, real rates are declining, gold responds well. The dollar looks to have peaked. That's another tailwind for gold. But the other factor, which we've been living with for much of the last 6 months, whether we're talking about the uncertainty over China, the ongoing conflict in the Ukraine, and the debt ceiling, one thing gold tends to work well as is a tail hedge when people are really worried about the wheels coming off.
Interesting. Russ, thank you. Russ Kostruck there of BlackRock. Gold up nicely year to date by 7 or 8%, TK. You've been looking at that, I know.
Oh, I always look at it. Dennis Gartman gave us a briefing yesterday. Obviously, he is in gold. He's always in gold. But what's fascinating off the Gartman call is gold in euros. Gold in yen. It's an extraordinary performance against yen. It's on edge of moonshot.
We haven't talked about the debt ceiling debate yet, have we? 314 to 117 through the House with ease. Speaker McCarthy calling it a bit of a win. You'd expect that. One key caveat, I think, to that win. More Democrats voted for this than Republicans. Bramo.
This is going to be a hard sell in the political theater sphere, which we're going to be hearing a lot of.
Next step to push this one through the Senate and get it to the president's desk. Coming up next, Heidi Kriebro-Rediker of the Council on Foreign Relations from New York City as we kick off the month of June. Welcome to the program. Equity futures positive by 0.2%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Iran has reinstalled monitoring equipment and boosted its cooperation with international inspectors, even as its engineers added stock to stockpiles of uranium. The findings by the IAEA in its quarterly report reduces the likelihood Iran will face censure when diplomats discuss its nuclear program next week. Around 50 Credit Suisse bankers are suing Switzerland's financial regulator for rendering their bonuses worthless. A Swiss federal court spokesman says they're suing over the write-down of so-called contingent capital awards. The bonuses were based on AT1 bonds, which were wiped out in the emergency rescue of Credit Suisse. NVIDIA's CEO is said to be heading to China later this month to meet with tech executives in the world's biggest chip market. A source says companies on his itinerary include gaming leader Tencent and TikTok owner ByteDance. The CEO's first China trip in years will come as the U.S. tries to curb Beijing's access to leading-edge chip technology. The U.S. House has passed the debt limit deal struck by Speaker Kevin McCarthy and President Joe Biden to avert a catastrophic U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday night.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the president's desk as soon as possible.
The compromise deal drew opposition from the flanks of both parties. Objections from conservatives could force days of debate in the upper house. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the president's desk as soon as possible.
House Speaker Kevin McCarthy, Senate Majority Leader Chuck Schumer passing a deal with ease through the House. Lawmakers from both parties voting for that debt limit deal at 314 to 117. As Senator Schumer pointed out, it's on to the Senate from here, potentially a vote on that Friday into the weekend, and then onto the president's desk. And Tom, hopefully we can all move on.
I don't think it's that easy. I think the Senate, Greg Villiers features it this morning. He thinks the Senate's going to be sport because of two senators, and we can go into that as they slow it down and block it up. Margot Sanger-Katz with a brilliant article that both Lisa and I saw in the New York Times. And I love this phrase, John. It's Thursday. It's not Claims Thursday. It's agreed upon adjustments Thursday.
Do you want to explain that?
Beautiful chart. Here's where we are now. Boy, are we saving a lot of money. Let's pull that puppy back over 24 months. And the answer is, Lisa, to me, the Sanger-Katz Parlapiano research in the New York Times, which I'm sure CBO will catch up on, is we're doing nothing here. We're spinning wheels.
Well, but that's exactly my conclusion. Basically, let's agree to disagree on exactly how to deal with the big problems and basically come up with window dressing to put on top so we don't actually have to.
Because 2 years out, we're going to readjust it with sidecar deals, John. I mean, it's almost like the British government.
Not quite. At least they agree on a budget and push it through. This is the new world, isn't it? And it's been going on for a long, long time. You manufacture a crisis and you negotiate the budget. We're going to see this act again and again and again.
Bring the banner up again on radio. I'm sorry. It's just too good to be true. Thank you, Margot, for this. It's agreed upon adjustments Thursday. They agreed upon adjustments down the road. And that's it. I mean, there's nothing really else to say. We're gonna go on right now from the budget, try to move away from that. Heidi Krebo-Redeker is with a senior fellow, Council on Foreign Relations, really writing as much as she can on what we were talking about yesterday and continue today with Rika Renminbi, and that is China. Heidi, thank you so much for joining. Is the China slowdown for real?
So I think, you have a lag in data and some revisions, and I don't know if we really understand if the data coming out of China is accurate, in part because they're coming out of a very, significant COVID lockdown. So just think back to when we were publishing our data and revising it after COVID. It's just, I think it's too hard to focus on just one number. I actually focus more on the youth unemployment number as being a serious concern for me.
Yeah, we'll go to that. You have a great transatlantic and frankly trans world, I'd almost call it, linkage between Europe and China. And you say EVs to the rescue for China, and that a lot of the doubt about China will be solved by electric vehicles and their growth. Discuss that export might we're not factoring in.
So I just got back from Europe, and China was a key part of all the conversations because of the U.S. EU Trade and Technology Council. And we had Secretaries Blinken and Raimondo there, USTR Tai. We saw kind of a focus just on the main bone of contention, which is that the subsidies for EVs in the U.S. are not offered to EU automakers because of the China components to the vehicles. But I think that you have this muscle memory of trade negotiators of going after what's happening between the U.S. and the EU, and at the same time you have China exporting more electric vehicles, more autos that are Chinese autos. Just a striking uptick in particularly EVs.
Lisa, there's the analysis, and the further analysis is whoever's out on Twitter trying to figure out when Mr. Musk's airplane leaves Shanghai.
Well, yeah,
that's happened the last 24 hours.
Exactly. I know that we want to move on from the debt ceiling, but I kind of can't yet, and I have to sort of pair it into the conversation that I'm sure, Heidi, you are having over in Europe, which is what are these subsidies going to look like, particularly when it comes to the recent tech-driven investments that the U.S. were promising to make. Did anything really change? Was any of the heft of some of those programs removed from this agreement that we got from the debt ceiling, or was it basically the adjustments that kind of came in after the fact and made sure it was all okay?
So, one of the great things about being overseas is that you really didn't have a lot of focus on the debt ceiling, as opposed to like living at 24/7 here. The focus on U.S. politics was much more driven by Trump and looking at the numbers and the upcoming election and whatever deals are being struck right now between the U.S. and the EU. Are they up for grabs if Trump were to win the presidency in the next go around? So I think, that's Trump played a prominent role and concerns in whether or not there was a need for Europe to hedge in its negotiations, not for all countries, but for some countries. And I think that's why we didn't see consensus, the same kind of consensus that we saw at the G7 and the Quad meetings in the past 2 weeks when we with our negotiators in Europe this week.
What does that mean with respect to U.S.-European alliance, with respect to China, with respect to some of these bigger issues, if there is sort of a pretty tepid receival of the United States with sort of ambiguous leadership?
So I think that the U.S. seems to be very much in line, and the Biden administration's in line with the EU Commission. It's just that there are 27 different member countries, and all of them are sort of playing out how they want to, how they perceive weakness versus strength and need to hedge. And because you have to have unanimity, it was in full display, and particularly around China this week, that you just don't have it in the EU, where you do, I think, really in Asia to a larger extent vis-a-vis China.
I'll be less diplomatic. You have the Commission and then you have Macron. And that's why things are confusing in Europe right now. And Lisa, that's been the story, hasn't it, for the last couple of months?
Well, yes. And Emmanuel Macron is like, hey, we're going to strike a deal with you. Go, China. Yay. Right. Let's go to Beijing and the rest of Europe. It's like, what are you doing? At the same time, I wonder how much reticence there is to really partner with the U.S. in light of some of the recent subsidies, in light of some of the potential volatility. You think this is just a Macron issue?
Oh, the reports I hear about how well-liked Macron is at the G7 is just kind of,
well-liked.
Or how...
Yeah, I was about to say.
Less liked, he's liked.
Right. I imagine that's the case.
That's me trying to be diplomatic. Heidi, thank you. Wonderful, as always, to hear from you. Heidi Krieber-Rediker there of the Council on Foreign Relations. Here's one for you. The relations around this. There's an OPEC Plus meeting into the weekend. This is from the FT, from Bloomberg, from a whole host of media organisations. Reuters, Bloomberg, Dow Jones banned from attending these meetings. That's got everybody's attention going into this.
Reportedly, there are some potential news outlets that have been invited, like the New York Times and CNBC, but it's unclear whether they will go. That is what I'm hearing anecdotally. The bigger question is, what are they doing? This is the first meeting where they're meeting in person. There are likely going to be output cuts that are going to be implemented in order to get the price up. What are they trying to basically message here?
Just before we went to air, Edward Morse published at Citigroup.
What did he say?
And the summary of it is simple. OPEC Plus and its, quote, market power. It was an exceptionally diffuse note by someone who is nailed the price of a barrel of crude. Ed Morse, more than anyone I know, has gotten this call right. And he says they're struggling with what is their market power. And I wonder if that's where this blockage of news organizations comes from, is they're petrified about how to get their message coherent, how to get their message out without the journalism that goes into questioning policy and the rest.
Well, to be fair, also, OPEC Plus and the countries that make up that cartel, not exactly known, many of them, for their free and open press.
Absolutely.
In their own countries.
Yeah. Well, and it's not like the media outlets aren't going to go and aren't going to speak to people who are in the room. So again, what are they playing at? Why is this? What's the signal here?
You can see it, can't you? Some of the media organisations on the outside just kind of texting the delegates on the inside.
You know, the phrase here is
getting the stories. Oh, yeah, sure.
I mean, come on.
The key phrase here is simple. It's Javier Blas's fault.
Javier Blas is coming up in about 20 minutes. Looking forward to catching up with Javier. Crude right now, 68 on WTI, totally unchanged. To kick off the month of June, equities slightly positive. From New York, this is Bloomberg. The scores are in for the month of May. Let's get to those scores right now. On the S&P 500, futures in June pushing a little bit higher, up by 0.26% on the S&P 500. For May, just about closed out May with a monthly gain on the S&P 500. A very marginal third month of gains on the S&P. Nothing marginal about it on the Nasdaq 100, up by almost 8% to close out the month. on the session right now, just about positive by 0.1%. You can thank the likes of NVIDIA for that. NVIDIA through May added almost $250 billion to the market cap in that company, Tom. How impressive is that? $250 billion US dollars.
I'm going to suggest we've never seen it, but I think a lot of other things lifted up as well. What's interesting is 1 year trailing, sell in May the last time around, NASDAQ up 7%, SPX flat essentially, and the Dow flat, a little bit negative as well. So it's been a 1 year churn here around all the emotion we're covering every day.
Yields are up through last month. They look like this right now. 2-year, 10-year, 30-year, higher again to kick off June by 4 basis points. Trim that monthly advance in yesterday's session. Right now, 444.64. So on the month, up something like 40 basis points on a 2-year as we started to price out cuts. I think pricing out cuts is the right way to put this as opposed to pricing in hikes. Pricing out those cuts, though, happen to drive some dollar strength with some real weakness in the data in China, in Europe. In the single market, looking at the single currency, the euro against the dollar shaping up as follows. Euro dollar 107.09, just reclaiming that 107 handle in the last hour or so. But on that currency pair, down about 3% on that currency pair through last month in May. That's the worst month this year. In fact, it's the worst month going all the way back to April of last year, Tom.
Can we all agree it's a surprise of the year? I think everybody was looking weak dollar.
There's been many.
There's been many. But
doubts about tech ripped.
Yeah.
Doubts about the Fed. They may hike again. Doubts about the dollar. Dollar's stronger, Lisa.
Surprise of the week, which is basically a year when it comes to 2023.
Hey, take your pick. I remember when everyone lined up saying, buy the banks. Remember that?
Oh, yeah, that was good. That was good. January, February.
Banks didn't work out either. Had a lot of Fed speak recently. President Harker on tap ahead of the quiet period. Fed Governor Philip Jefferson signalling a pause may be in store with more hikes to follow. A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. He's sounding more and more like a Fed vice chair, getting a committee together. Look, there is consensus on the committee right now. It's on two things. One, no cuts. And two, if we do skip June, we're not calling it a pause. So you can just see how the language is shifting. And if you wanted to find consensus on the committee, if that decision was today, you can see where Chairman Powell would find that consensus.
But the answer is what they're all on the same page on is they're all looking at the data. I mean, they are slaves to the data right now. And the labor is we had Randy Krauser on from a couple of weeks ago, and the answer is unemployment, jobs hasn't broken.
Elisa made this point earlier, though, Tom, and I think it's a really important one. Some people might interpret the comments of yesterday as de-emphasizing the data that comes out tomorrow.
Yeah, fair.
De-emphasizing CPI.
And
really emphasizing that we can skip June, wait and look at what the data that comes together ahead of July.
Can we get existential?
If you want to, sure.
What if the Fed does in a quiet period and they get in the quiet car and the Excella? What happens? It's like Stephen Wright, the comedian.
1-800 Wall Street Journal and plant a story again. Say we're hiking because CPI was too hot.
They can't. They do it by text because it's the quiet car.
What do they call that? Nikki Leaks over at Wall Street.
That was our Stephen Wright moment there. Quiet people on the quiet car. Let us move forward now, and it is our immense pleasure to speak with Alan Ruskin, Chief International Strategist at Deutsche Bank. His notes are absolutely fabulous. You can get them, of course, through Deutsche Bank. Alan Ruskin, you have an absolutely brilliant paragraph on M2 dynamics and nominal GDP. Is the surprise of the next 12 months forward that we have sustained nominal GDP because of sticky inflation?
It's a little bit like that, Tom. I think we're, going to see, for example, data today which shows that productivity was extremely weak in Q1, but not just Q1, on a trend basis, it seems. And that weakness in productivity translates to high unit labor costs, which is sort of stagflationary. And output, we know, is relatively weak relative to employment. That's part of the weak productivity story. So it all adds up to nominal GDP doing an awful lot better than real GDP at this point. Some of this, I think, is just this natural overhang from the M2 growth. We had, something like 30% M2 growth above trend a year ago. That's down to about 20% overhang thanks to weaker M2 growth that we've seen more recently. But still, I think that's really propping up the nominal numbers, but monetary policy and money supply is a veil. It doesn't ultimately pay you to print money. It doesn't generate real GDP growth.
The real GDP growth is the recession game. Your colleagues have been brilliant on this. Matt Luzetti has arguably the single best recession delay call of the last 18 months. Reframe that now. I'm not saying agree with young Luzetti, but at least frame out the Ruskin recession to come.
Yeah, I've always been of opinion that given the overshoot on inflation, even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario. I know that's semantics in a sense, but I think we're still pretty much on track. But we do need to see some weakening in the labor market. And of course, everything we saw from the openings data yesterday suggests that employment will remain relatively resilient. So you've got this weird dynamic again, whereby employment is relatively strong compared to output. And particularly, I think we're seeing weakness in the manufacturing sector worldwide. So there's another story there as well. But I would say that we're still on track for something which skirts recession/shallow recession, but it's not looking like a deep recession unless we get some sort of non-linear event like the banking sector crisis sort of really taking hold and a proper credit crunch, which we have not actually seen as yet.
You mentioned manufacturing, Alan. That distinction, I think, is so important. Manufacturing PMIs worldwide, Europe, China, south of 50, contraction rate, throw in the United States, pretty ugly there. It screams rate cuts in some places. Then you look at services, Alan, which make up the bulk of some of these economies, still pretty robust. Alan, the surprise of the last month or so has just been the breakdown in another consensus trade. Dollar weakness to dollar strength. Alan, as you look at things right now, have we broken that trend? Is this something new? And if it isn't, where does that new engine of dollar weakness come from?
I think it's deferred dollar weakness. The whole idea of a divergence trade that worked against the dollar, whereby Europe, if not outperforming, at least the ECB was hiking whilst the Fed was on hold, and China was obviously sort of reopening and strength that we would expect there, or what we did expect there. A lot of that just hasn't materialized. In fact, if anything, the US has been more resilient than anticipated. And, consequently, I think what you're seeing on the exchange rate is very much reflective of what you've seen on interest rate spreads. So the interest rate spread story is just taking its cue from this relative growth story. I think right now, it depends on where the Fed goes. For example, if they hike in June, it seems less likely after yesterday's Fed comments. But if they hiked in June, I think we'd be down at 105 on euro dollar. If they don't hike in June, we can trade here in the sort of 107 sort of area for the time being as far as euro dollar is concerned.
Alan, you had this really interesting point in your latest note where you basically were saying there's a little risk of over-tightening. That does not seem to be the theme that we're hearing in the Fed speak that's been coming out every day, day after day. Can you explain that, what that means as to where policy should be, where it will likely be, and what that means for longer-term inflation?
Yeah, I think just look at your financial, conditions indicators. We all have our own numbers, but if you look at the Bloomberg numbers, for example, you look at, say, 6-month financial conditions, 12-month financial conditions. If anything, they've eased rather than tightened, which is truly extraordinary. So the tightening needs to come from something like the credit side. You're not seeing it in terms of credit prices, particularly. Maybe, issuance markets are tight and closing up. But in general, you're not seeing this kind of non-linear event that I think would have tightened financial conditions sufficiently to really risk over-tightening. Now, maybe the Federal Reserve, which has, some distinct advantages in this sphere, and knows a little bit more on the banking sector side. It's clear that you do need additional consolidation over the longer term. But I think that holds the key as to whether financial conditions tighten materially. It looked like they were tightening sharply, a couple of months ago, and now much less so.
Alan, wonderful to get your view. As always, Alan Ruskin there of Deutsche Bank. Thank you, sir. We always talk about moving fast and breaking things. The Fed has moved really, really quickly, and some things have broken. Let's be clear about that. But this economy is moving much more slowly than people anticipated. If you think about Chairman Powell, and we often reflect on that speech in Jackson Hole, what was it, 8 minutes? 8 minutes, Chairman Powell, we're going to do more, we're going to do more.
Still sitting
The
here
end
now.
of August, we need to cause some pain. If we don't cause pain, it'll mean even more pain down the road. Unemployment's at 3.4% going into payrolls tomorrow. And take the last month for that matter. When we started May, we were just coming off the banking turmoil for the regional lenders, and we were all anticipating this aggressive tightening of financial conditions and lending standards, and that's what Alan's alluding to there. Lisa, it's all just happening much, much more slowly than people anticipated.
And the pressure to buy is still there under the surface. And I thought that Michelle Bowman really reflected that well yesterday, the Fed governor, when she came out and said what you can see is that any kind of loosening whatsoever in financial conditions, any kind of decline in mortgage rates, re-up the surge into housing. Immediate prices go up. So basically they can't kill it with rates that are much higher, that are more than double where they were before on an average. This to them indicates perhaps there is this excess that really hasn't been beaten out of the system yet.
But this is why they're so nervous about the next decision. You get lulled into hiking too much, don't you? And I think the balance of risk has clearly shifted for them too. We close out 2022, the risk of doing too little outweighs the risk of doing too much. What about now? Ask them that question now. Where do they stand on that now?
They want more time to see. The data's been confusing. The data's been all over the place as we talk about the whipsawing of yesterday's information that came out. How much can they really have conviction at a time when there still are the lag effects? And I do have sympathy for that, but at the same time, it's unclear whether the risks of a reigniting inflation are really off the table.
Sympathy for the Fed. Where's Bramo? Where's the real Bramo?
It's not. Hold on a second. It's not
took
sympathy.
like 6 days
An
off.
imposter around the table.
Yeah,
No,
I know.
I'm not. It's not sympathy for the Fed. It's sympathy for the plight of trying to understand a moment that is highly complicated.
Okay. Came into the studio this morning. Always the last one in. Bramo's late. Often happens.
Well, her entourage.
Comes in with the entourage.
And happy.
So, like bouncing off
And
the walls.
And then yelled at for being happy.
Bouncing off the walls.
How can you?
Well, it just didn't have any authenticity.
Oh, come on. I was super happy. Trust me.
I think the audience at home would agree with me.
I'm
Like,
thinking
just
of buying
didn't-
a puppy.
It didn't really.
There you go.
Really?
Go get two. No, dive in. Get two. Get two.
7:30. Let's see if Deborah Cunningham of Federated has any sympathy for the
brace.
Federal Reserve.
Oh, come on.
That conversation in about 50 minutes. Have you become friends with the chairman? Is that what this is about?
Honestly, I'm sympathetic to the plight.
Interesting.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. NATO foreign ministers will discuss Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. Meanwhile, Ukrainian President Volodymyr Zelensky made an unexpected appearance at a summit in neighboring Moldova. Now, the summit is taking place less than a dozen miles away from the breakaway region of Transnistria, which hosts Russian troops on Moldova's eastern border in Ukraine. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a coalition of patriots. Former European Central Bank President Jean-Claude Trichet says despite an environment of great pessimism, Europe's boldest endeavor was the creation of the bank. He spoke to Bloomberg on the ECB's 25th anniversary.
Also proved something which is very important, I would say, historical trend. We started with 11 countries, we are now 20 countries. In my 8 years of mandate, I welcomed 5 new countries, you see. So there is something underlying, which is very strong.
Meanwhile, Vice President Luis de Guindos says that the ECB is in the final stretch of hiking interest rates, with further decisions to be data-driven. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
I think the speculators, like anything in any market, they are there to stay. I keep advising them that they will be ouching. They did ouch in April, but I would just tell them, watch out.
Prince Abdulaziz bin Salman, the Saudi energy minister, last week at the Qatar Economic Forum, speaking with Francine Lacroix. Great conversation. It's always the short side they're unhappy about. You notice that? Whenever we talk about speculation,
oil's going to 100
level, it's always the shorts.
Yeah.
It's like those speculators. Nothing speculating about being long, but being short, that's problematic.
Okay, well, if it is speculators, then how are they going to justify the rate cuts, the production cuts that they're going to implement if there's no fundamental basis to where we are? I'm just saying.
They want to flush them out. If you look at the fundamentals, and Grant Smith did a great job on Bloomberg today, just kind of breaking this down. On the one hand, inventories are shrinking. On the other hand, you've got weaker data out of China. Just trying to put it together right now about what the right policy would be, Tom. I think it's not so straightforward.
Correlated in a Bloomberg commodity index, I should say, it's certainly been a weakness for commodities. This is a real joy. Javier Blas, the book is The World for Sale. He is definitive on hydrocarbons. This is the conversation of the day on OPEC Plus. We're thrilled that Mr. Blas could join us with Bloomberg Opinion. Javier, I'm going to cut to the chase, and I do not want you to speak for Bloomberg and other news organizations about the back and forth with OPEC Plus. I don't think that would be appropriate right now. But I do want you to speak about your essay the other day of the Aramco illusion that's out there, a brilliant piece on the illiquidity of Aramco. That speaks to an OPEC Plus that wants to play by its own rule book. What is the OPEC Plus rule book to get the price of oil higher?
Well, Tom, what OPEC has been trying to do is cut production, argue that they are cutting production because they believe that there are too much speculation into the market, that they are not targeting oil prices, that they are trying to increase investment into the oil industry for future oil demand. At the end of the day, the rule book of OPEC is to keep prices as high as they can. It used to be $50, it used to be $70, and clearly now OPEC is trying to keep oil prices the closest that they can to $100. That's the price that Saudi Arabia clearly is targeting. And it has not been able to do so, not so much for the demand, which doesn't look great for oil, but it doesn't look too bad. The main problem is there is a lot more oil coming from places like Russia than anyone was thinking 6 months ago.
Javier, I took Log Saudi Light yesterday, went back and did a careful study of the collapse of 1986, seared into the memory of all of OPEC and particularly Saudi Arabia. That gets us down to a barrel right now of $40, $42 a barrel. Are they worried about the ghost of 1986 or other times we've seen oil slide?
I think that is always present on the memory of any Saudi oil minister, including His Royal Highness Prince Abdulaziz. And they speak about avoiding the mistakes of 86. I don't think that we are facing any situation similar to that. There is not the amount of extra production coming from elsewhere in the world as it happened in 86. And also the demand growth for the next 2-3 years still looks relatively okay. It is a question of what is the price of oil that balance the market. And at the moment, that's closer to 70 than it is to 100. And the other big problem to Saudi Arabia is that we have had quite a lot of accumulated inflation. We are looking at nominal prices for oil, but the purchasing power of the barrel is a lot lower today. What $70 today oil buys you in the international market when you are importing goods is a lot less than 5 years ago and 10 years ago. Those $70 start to feel very much like $50 a few years back.
We started the conversation talking about the gathering in Vienna, the in-person gathering of OPEC Plus, where certain news outlets are not invited. In a departure from the past, it seems like there is a bit of concern or disagreement with the message that's been getting out there. What does OPEC Plus not like in terms of messaging?
Well, I think that they don't like low prices. They would like higher prices. They don't like low prices. They don't like to see numbers of Russian production that they are much higher than they would like to see, and they would like to try to convince the market that everyone is cutting production as much as they are saying. News organizations like Bloomberg report things as we see it, and we have been not invited to attend the next meeting alongside reporters from Reuters and the Wall Street Journal. For me, I have been covering almost every OPEC meeting for the last 23 years. It is a first. But we will still continue covering OPEC.
And we'll probably be in Vienna having conversations with people who are in the room. I am curious, though, just going forward, if the concern is how the messaging is with respect to Russia and its production of oil, What's the meeting going to be like in terms of the tenseness between Russia and Saudi Arabia?
I think that everyone is going to try to put a brave face in Vienna this weekend. Agree that the production cuts are happening, and try to put a spin into the market that things are going to get tighter. And if you look at the forward balances for the second half of the year, it looks a lot better for OPEC. And even with the extra Russian oil, the extra Venezuelan oil, and more barrels coming here and there from Iran, things will be looking a bit better. The market looks as it's going to tighten into the second half of the year. So in some ways, it is surprising because it is not like panic situation. After all, Brent is trading close to the $75. I mean, my big surprise is that there's almost a sense of panic inside OPEC when the market is trading quite healthy, close to $75 a barrel.
But how much is this panic, Javier, that they're losing market share to Russia? That basically Russia is selling to China at a disproportionately high amount, stealing some of the business that OPEC Plus used to rely on, or OPEC without the plus. How much is that kind of the tension underplayed here that really has to do with China, where demand is, and why perhaps the demand there hasn't influenced pricing as much as people thought?
It's true that some OPEC nations are losing market share into the east of Suez, as we call the Asian market, to Russia. It's true that Russia is selling more oil into China and India than it used to. But it's also true that for OPEC countries, including Saudi Arabia, the European market is now their new home. Russia is not selling in Europe, so the Saudis are capturing market share there. So yes, while they are losing market share in Asia, they are winning market share in Europe. At the end of the day, it's a balancing act.
Yeah. Javier, you're world expert at all of the investment that goes into this. There's been a number of essays under your purview at Bloomberg Opinion on where price is and the motivation to invest in hydrocarbons. Is the price now shattered enough where we're going to see a dearth of investment in oil?
I think that the price have come down enough, around $70 WTI, around $72, $73 Brent, for some investment to be posed. We have seen a significant decline again in drilling rigs in the United States. And it's a combination of the price and also a new mentality in the industry that shareholder come first, that the industry needs to make enough returns so the shareholders are there. And we have seen that on shale. And certainly at some point we are going to miss that growth of the shale industry. And it may mean that the likes of the United Arab Emirates and Saudi Arabia can produce more oil going on in 2024, 2025 and onwards. But yeah, I think that prices have come down enough that investment into the industry is gonna start to suffer, at the very least at the margin.
Javier, you get to decide. Are we congratulating Sevilla or not?
Can I pass on that one?
I'll take a pass too. Javier, thank you. Javier Blas of Bloomberg Opinion, thank you very much. For any Sevilla fans, congratulations. Okay. Penalty shootout with Roma yesterday. Ugly penalty shootout.
Sincerity, really.
Ugly game. Just two teams that don't play. Let's say Sevilla doesn't play attractive football. It's kind of the dark arts of football. It's quite defensive. Throwing themselves on the floor a lot.
Literally?
Protesting to the referee.
Are you just asking for hate mail?
Lots and lots of that. I'm not sure how big the fan base of Sevilla is.
Okay, so you can...
I think I can take this risk.
I watched the other day for like 10 minutes. It's all I could take because of Sevilla against I can't remember who, because they're all falling down, just like you said.
Was it against Juventus? Might have been against Juve.
Can't remember.
That was a semi-final,
but
yeah.
Everybody was falling down. Oh, yeah, I just can't. Americans...
Probably not, probably still in bed. Would have been drinking all night. Congratulations for those of you that did wake up.
Do you know that female soccer players don't do that?
Impressive.
Women's soccer,
You've got the
yes.
data for that.
Actually, there is data somewhere,
That's
but
very
they
cool,
do
so.
fewer sorts of
Simulations.
fake out, simulated kind of, oh my goodness.
Interesting.
What do you think about the long minutes at the end of the game? It used to be added 4 or 5,
it's
and
odd.
now it's 8 minutes.
Call it 10 sometimes.
Well, is that a big deal?
They need to work out how much time is wasting. The ball is not on the pitch enough. That's in the data, you can see that, and they're trying to work out how to address that problem.
Another nerd soccer question.
Sure.
When they set up for a corner kick, they never put the ball in the white line. They always cheat
It just
in
has to be slightly over the white line.
Okay.
Yeah. So the edge of the ball might be over
They're like
the white
always
line.
cheating it.
Yeah, they're trying to work it out. Yeah. But there is a rule there, Tom, that
We'll
makes
talk
sense.
balls and strikes in the next
Let's
hour.
not do that. Tracy McMillan of Wells Fargo joins us next. Welcome to June. Your equity market up.
demand is starting to slow. We're seeing that way back in the supply chain.
The real question is, are investors pricing in growth opportunities over the next 5 years?
This has been a very slow-moving economy and market. If you have super high conviction right now, you're not paying attention.
What we've seen so far seems more consistent with a soft landing in the labor market.
We still think we're going to be in recession by the end of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Something for everyone in retail. You've got to work out, is this a story about Macys or a story about the economy? Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures just off session highs, positive by 0.2%. But the outlook from Macys, the department store here stateside, absolutely ugly, Tom. The stock performance, the price, down 12%.
Back to where it was, off the pandemic with a nice little bounce here. There's been some enthusiasm. We heard the wonderful Oliver Chen on this with Cowen recently. You know what, John? It's just as simple as this. You've got Macys negative 8% per year over the last 10 years. This has been a mid-market train wreck over the long term.
Some of these headlines on a consumer, excess merchandise, markdown still to come, Bramo demand trends weakened in discretionary categories. Macro pressures on the consumer, they assume that gets worse. Now, just looking at this pouring out, and we were all talking about this in the commercial break as these headlines dropped, Lisa, it's very difficult to get a broad understanding as to what is going on with the retailer right now. Because if you look at Macys, they're telling the consumer's not great. You look at another retailer, they'll tell you everything's okay.
We heard from Nordstrom's yesterday, and it was better than expected, so we saw those shares up. So basically, to your point, is this a Macys problem, or is this a broader issue? How much is this also just ordering the wrong types of stuff in still a pandemic economy? We've talked about whether it's people going back to work, going back to the office, now staying home, all of these different trends. The bottom line is this. They clearly are seeing something very significant in terms of weakening, even after all of some of the negativity priced in. There has to be this question of, is this particularly on the lower end of discretionary spending?
Just to bring you the headline from Macys then, this is their full year outlook, a range on adjusted EPS to 270 to 320. They had seen previously 367 to 411. So that's a big drop away. That stock is down, as I say, by about 12% right now. We'll pick up on that story in just a moment. Here's the broader price action for you on the S&P. Just pulling back from session highs. Equity futures on the S&P 500 right now, positive by 0.2%. If you're looking at the bond market, Treasuries at the moment, yields higher, Lisa, by a couple of basis points, 366.
Yeah, and we'll keep looking at all of the different retail earnings throughout the day. We also do get some economic data, jobless claims at 8:30 a.m., an ISM May manufacturing PMIs at 10 a.m. All of this to really get a sense of what the noise is and what the signal is. It's been really tough given all of the divergences, both within the data as well as in the earnings. Patrick Harker speaks at about 1 p.m. of the Philly Fed. It probably will reiterate what he said yesterday about a pause, skip, whatever you want to call it. We hear from banking executives today, including Goldman Sachs' John Waldron, Bill Denchek of PNC, as well as Brian Moynihan of Bank of America. This is at that Bernstein conference. Very curious to see what they have to say about the consumer with a bit more of a bird's eye view. And I want to go back to those retail earnings. The idea that Macys downgraded their expectations, downgraded their sales, just the idea that full year sales now they're expecting to be $22.8 billion to $23.2 billion versus the prior guidance of as much as $24.2 billion. That, to me, it really signals perhaps a very specific trend that we're not seeing in places like Nordstrom, but really do signal that there is some sort of softness out there. We get after the bell Lululemon, a higher end kind of retailer. Curious to see what comes from there. But Nordstrom shares are up today, John.
There you go.
And so this is the confusion. Is this a Macy's story or is this a broader issue? But Nordstrom did well on the off-rack brands, so the ones that were more discounted-oriented. How much is this really an issue of strategy at a time when the economy is in transition?
Don't you find there's just something for everyone? We get ISM manufacturing. You went through the data later this morning. You look at manufacturing, it says ugly, economy not great. You look at services, brilliant. Look at the airlines, go to an airport, super busy.
This is why it's so confusing, and this is why I didn't say I had sympathy for the Fed, but I understand the difficulty in discerning what the trend is at a time where you have retailers coming out with some pretty negative projections, others coming out with positive, and the retailers and airlines are doing gangbusters.
It speaks to America. There's different things out there. I think of Kohl's KSS and the challenges they had in the last thing. This is middle America, mid-market America, however you want to gloss it over. To compare and contrast here, try to get these banners up, Amy, as you can. On an EBITDA margin, we're on an NVIDIA frenzy. Talk about the profit of retail. EBITDA margin, Macys, 10 cents, 11 cents on the dollar. NVIDIA, 40 cents on the dollar. Those are the profit machines everybody's focused on. And then you look at gross margin. I did this for you, John. And you got gross margin. You got Macys at 39 cents on the dollar before a lot of other expenses come out. And LVMH it's almost a double, 68%. This is about mid-America flat on its back.
Let's get to the CEO's quote on what he's seeing right now. Jeff Gennett saying this: "We planned the year assuming that the economic health of the consumer would be challenged. Starting in late March, demand trends weakened further in our discretionary categories." That stock is getting hammered. Tracy McMillan joins us now, Head of Global Asset Allocation at the Wells Fargo Investment Institute. Tracy, do you think that's a story about Macys, or is that a story about this economy?
So it's probably both. It's probably a story about the bifurcation of the consumer. The top 2 quintiles seem to still have purchasing power. The bottom 3 quintiles do not. And we're seeing much higher credit card rates. We're seeing much higher auto loan rates, and that is hurting the bottom end of the consumer. There's this mountain of cash that consumers had on their balance sheets, and we see that starting to dwindle now.
Well, you mentioned that to me, Tracy, before when we saw the shock of the Macys news, and you're talking about a consumer that's dwindling away. Are they dwindling away into a legit NBER recession?
So we think so. We think that this is a recession postponed, not canceled. And as that mountain of cash dwindles, it should decline at an accelerated pace, especially as we see student loan payments starting to resume. At the same time, there's going to be more of a fiscal drag. And we don't think that the Fed is going to come in here and rescue markets. We don't think that they will be cutting this year. In fact, we see another rate hike.
Tracy, what data are you focusing on, given that there are these really divergent views depending on which data points you pick up on?
That's very true. The data is very mixed, and that's not uncommon at a turning point in the markets. One of the things that we're watching, especially this week, is labor market news. The labor markets are still very strong, but they're starting to slow down. In fact, tomorrow's non-farm payrolls have an estimate of 235,000 jobs added. But we've now seen 3 months in a row, and this will make the 4th month, of sub 260,000 jobs added. That's the first time since the pandemic that we've seen the payroll slow down that much.
What's really hard about the data right now is it really depends on what your bias is, how you read it. Some people say that they're seeing softening in the labor market. Other people say, what are you talking about? We just saw a JOLT survey that came in, surprise to the upside, blew all expectations out of the water. You could see those help wanted signs in every store around the country. You've got a lot of constraint on that point of view. What are you looking at to show this market slowdown? Or is it that everybody is looking for it and finding it, in places, and then kind of confirmation bias? It's sort of like, okay, well, that's what we should focus on.
Yeah, I think it's really looking at the traditional indicators of recession, seeing that those are pointing towards a recession, seeing a Fed that is actually convinced that they need to continue to quell inflation, continue to slow the economy. So actually those jobs numbers and the JOLT survey are not good news for the Fed.
Tracy, asset allocation. Boy, it's mid-year correction. John Ferro's year starts March 31. We're deep into the Ferro year. How do you reallocate right now on a 60-40 strategy?
So we would be overweighting fixed income relative to equities, and we'd be up in quality in both of those asset groups. So we like large caps over small caps. We have moved developed markets back to neutral from an underweight. And within fixed income, we like short-term and long-term. We're barbelling that in investment grade over high yield.
Just within DM equities, is there a bias towards the United States?
There is a bias toward the United States in that we have overweighted the U.S. markets, but we are starting to add money back to European markets, mostly on valuation and the idea that the dollar is probably peaked. Interesting.
What tells you the dollar's peaked?
So we think that the dollar has probably peaked because the U.S. is probably near the end of its tightening cycle, but we don't think that the Eurozone is near the end of its tightening cycle. And the Japanese economy as well has been performing fairly well. The Japanese markets have been performing fairly well, and they too could see tighter monetary policy as the year progresses.
Just quickly then, what do you think explains the strength in the US dollar in the last month? Because everything you've said has been true consistently through the whole year.
Yeah, so we think that the strength in the dollar really is off of the debt ceiling deal. The dollar does tend to move up about 2% once a debt ceiling deal is reached. So we think that that's probably behind a lot of it, but in the Eurozone, I think that there's some discounting going on there as well, as Germany has tipped into recession.
Yeah, the data there's weak. China as well. Tracy, thank you. Tracy McMillan there of Wells Fargo. I'll catch up with Sam Linton-Brown of BNP Paribas a little bit later. So a lot of people come on, like Tracy did there, and they talk about how the ECB is going to do more than the Federal Reserve. Backed up by the ECB this morning, President Lagarde still have ground to cover on rates. You don't hear that from the chairman of the Federal Reserve in quite the same way. Got it. Sam Linton-Brown thinks it's less about that and more about the potential damage that will be done to the economies from the cumulative tightening already in the pipeline. And arguably what you're seeing so far, and this is my view on things and not his, is that what you're seeing so far is that the US economy is standing up to rate hikes better than Europe is right now, based on the weaker data we've seen so far.
It's the conflict right now in the FX market between just simply monetary policy versus economic growth. And that, I think, has been the tension, which has made it very confusing to figure out the right kind of direction here.
Other factors in the overwhelming first-order condition for America's technology. We own it. They don't.
Exactly. You can find NVIDIA on the NASDAQ. You cannot find that on the Euro Stoxx 50. Yep. I can get you some LVMH, though, Tom, if you fancy it.
Well, you know, what is it, 21% of the French GDP?
Not quite, but it's
Macron's closet is jammed with them, as I say.
Up next, we'll catch up with AMH down in Washington, D.C. The debt deal passes the House. Now it's on to the Senate.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. As Jonathan just mentioned, the House passed debt limit legislation forged by President Joe Biden and Speaker Kevin McCarthy that would impose restraints on government spending through the 2024 election and avert a destabilizing U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday evening.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for.
Now, that measure now goes to the Senate, where approval is virtually certain. Mitch McConnell says a vote may happen as soon as today. Serbia's president called for the removal of new mayors in northern Kosovo. The flare-up started last week as the newly appointed mayors started to take up their posts in northern Kosovo. Tensions escalated on Monday when Serb protesters clashed with Kosovo police and NATO troops, leaving 30 peacekeepers and dozens of protesters injured. And Amazon has agreed to pay just over $30 million to resolve two cases brought on by the FTC. Now, in the first case, the agency says the company didn't take enough steps to protect the privacy of users of its Ring video doorbell. The second case involves Amazon's Alexa-powered speakers, which the Justice Department says collected information about children under the age of 13 without their parents' consent. Amazon disagrees with those claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the president's desk as soon as possible.
Now it's on to the Senate. That was Speaker McCarthy and Senate Majority Leader Chuck Schumer. As Schumer pointed out, it's on to the Senate after a 314 to 117 vote in the House, passing with ease, but with a lot of help from Democrats. And I think that's the wrinkle in Speaker McCarthy's case. A good deal, Tom, in the eyes of a lot of people who voted for it, obviously, but that one small wrinkle, more Democrats voted for it than Republicans.
And that's a House debate as well. I would say the focus, maybe not on the zeitgeist now, but certainly tomorrow and into the weekend, is the Senate. And, I think that's...
You think this drags or has the potential to drag? Maybe beyond
I'm
this
listening
weekend?
to experts. I'm not an expert on this. I'm listening to the experts, and they say, look at Paul of Kentucky, look at Mr. Graham of the Carolinas, and they've got a lot of reasons to slow this thing down.
Isn't that part of the game, though?
Yes,
just sort
the
of
game
engineer
is
some,
exactly.
it might not
yes.
pass. You need my vote. Nah.
Yeah.
Do that.
That was good.
Should I be worried? I'm trying to work that out. I think a lot of people are this morning. They just want to move on. Should anyone be worried?
No, I think the tone is we're moving on, but maybe others like Anne-Marie Horton would tell us not. What do you think, Lisa?
You should always worry, number one. But number
Here we
two,
go.
I would say
Just a default position.
Default position should be worried.
That's the subtitle for the program.
We'll just
You
say
should
this.
always worry.
You should always worry. But it's a longer-term worry now of what happens with some of the serious issues that are clearly agreed to disagree upon and
I
discussing.
love it. This is great. So the surveillance newsletter, which, by the way, comes out when? 9:30?
About that, we try.
14 pages.
Great.
like
So here's the
10.
plug. Go to bloomberg.com/surveillance and you can sign up to that newsletter.
It's always
You should
worried.
put at the end of that, you should always worry.
All right, I will, and I'll let you know
Why
why.
don't you do a little thing
Worry
at the
in
bottom, like you do a footnote on
Love
each
it.
page?
That's great. That's great.
Here's why you should worry.
Here's why you should worry.
Newsletter's been a huge success. This is all Bramo. It's a Bramo project. She's got how many interns on it?
I'm pretty sure that everything
4?
Bramo does is a success.
4 interns?
4 interns
I think
working
it's
on
4
this.
interns because we're ramping up for the summer here.
Yeah.
It's really worked out.
Bramo taken 100% of the intern allocation this summer.
Oh,
You heard
yeah.
about that? Got the memo? Got the memo.
Yeah, I got the memo on that as well. Speaking of interns, Anne-Marie Horton will have 4 or 5 this summer in Bloomberg, Washington. Always a good place to do your internship. She's our Bloomberg, Washington and debt correspondent. Anne-Marie, I got a bunch of questions, particularly about Rand Paul, the senator, but I've got to go to Margot Sanger-Katz's essay in the New York Times about, I love this phrase, I just can't get over it, agreed upon adjustments. What's the ballet here? To get to the election of November of 24, to get to February, agreed upon adjustments means that what McCarthy said last night is a fiction. Where are they trying to get to? Where's the outcome of this?
Well, a lot of this has to do with this debt ceiling bills. There's a second part of this, and this will happen in the government negotiations and the spending process in the appropriations meetings. And this is about government spending, but they have agreed upon the caps between the Biden administration and McCarthy. But obviously, many people are poking holes that potentially this could be more fudged. What you heard the speaker say, though, to Hugh Hewitt when asked about what's next, he said we need to continue this fight, take it into appropriations, and make sure we are getting rid of, quote, wokeism and eliminate some of this higher spending he feels like they have seen from the Biden administration. So this fight will continue, and it's why many people are poking holes into how much actually this deal would reduce the budget. The CBO says it's $1.5 trillion. I believe in that New York Times article, their analysis was more like $1 trillion.
Right.
What I think is interesting is how the Wall Street Journal frames it this morning, Tom. They say that this sounds like a lot, $1.5 trillion over a decade. But that simply means that the federal debt, now 97% of gross domestic product, will rise to around 115% in a decade instead of 119%. And that's if you assume that the Trump-era tax cuts are good-nighted after 2025. Right. So this is very small. That's the takeaway. It's a slice of a slice that they're able to cut because they're not going after the big parts of U.S. spending.
I want to get out front, Anne-Marie, of your path to next week, which is the ophthalmologist from Kentucky. What is Rand Paul going to do to block this process in the Senate? The guy won 62% of the GOP vote in a very Republican Kentucky. I get it. But is he really going to gum up the machine?
Well, as Greg Valliere calls him, an irritant at times for the Senate process. It's not just him, though. We should note there are other individuals who, listen, they at least want their amendments to be heard, whether it's Ron Paul, whether it's Mike Lee, whether it's Tim Kaine of Virginia, who's had some harsh tones and criticism of the White House because of the Mountain Valley pipeline that is in this debt limit bill. These senators, I think, at least want to make sure they can have their amendments on the floor. But I would say Mitch McConnell has done this how many times now? And what he has said is he could see a vote as soon as today. So I would say he has been working the phones to make sure he can get everyone in line. There is also this idea in Washington, and some political analysts were talking to us about this last night, this idea of jet fumes. It's close to the weekend. They're exhausted. They've had enough of this. A lot of them have been dealing this since January, thinking about how this was going to end up, the showdown of this would look like when the Treasury was using extraordinary measures to pay our bills, and they're ready to go home. There is potential for some cumbersome process, but there's also potential that a lot of this is being done in the background, and they might get out of here even before Sunday.
And now we get the spin cycle. Ron DeSantis going over to Iowa and saying to Trump, you're trying to lead. Where's your view on the debt ceiling? I already came out against it. What's your view on that in terms of whether we expect to hear something from Trump and whether this is going to be used as sort of the political football du jour?
I'm pretty sure everyone on the Republican side who wants that nomination has come out against the debt ceiling, barring the former president. But we already know what he's had to say about the debt ceiling, although his comments on the debt ceiling have changed dramatically. When he was president, he said he thinks it would be crazy for anyone to use the debt ceiling as leverage. Then, out of his presidency, he said it should be used as leverage when I'm not president, but should not be used as leverage when I was president. And then he also said recently that the Republicans should go up to the brink or even default to get what they want out of this. So his tune has changed a number of times. But talking about what Ron DeSantis is saying, he is in Iowa. He's leaving Iowa. The former president is now touched down in Iowa, this key state for Republicans, and he's giving a town hall with Sean Hannity. So I'm sure this question will be asked, and we can get his final thoughts on this McCarthy-Biden debt deal.
Oh, Bramo, if only campaign politics right now was just about that. It's not about that. AMH, is it DeSantis or DeSantis? What is it?
Let's say this. I have a lot of Italian friends and family messaging me, asking me why he's pronouncing his name differently. I think, depending on who you talk to, but the governor is saying DeSantis.
But hasn't the governor gone back and forth on that as well?
Yeah, as has his wife. His wife has pronounced it differently as well. I think it's DeSantis.
Yeah, but that's typical.
We'll leave
it to the governor to decide how he wants to say his name.
Well, I think we need to agree on that before the campaign really gets going.
I would agree. We ask that all the time.
Amory, DeSantis?
Yeah, DeSantis.
DeSantis.
No, but you just said it differently.
Oh, make your mind up, AMH. Come on. DeSantis.
It's how much you emphasize the DEE part. Some people are saying he just wants it to sound more American. Obviously, his last name is of Italian roots.
Right. Okay. AMH, thank you. Anne-Marie on the latest. TK, you're obsessed with the zeitgeist, so to speak.
Matters.
That's it right there. Yeah.
Well, politically, yeah, I think that's the zeitgeist. I mean, politically, I'm looking at the markets here. I mean, John, look at the market lifting up this
You're being
morning.
sensible for once. Okay. Yeah, up by 0.2% on the S&P 500. Great note from Axios this morning, by the way, on that DeSantis stuff, but actually they led with something else. Is the Great Resignation over in America? Because the JOLTS numbers showed surging vacancies again, and that was the headline, and I've got all of that. Beneath the surface, the quits rate actually fell back to a normal kind of level, Lisa.
2019 levels. It was confusing data, so just ignore it for a month.
Oil just rolled over.
Okay. It's like market roulette with you this morning. I can't keep up.
It's fascinating.
Equities up in May, up in June for about 5 minutes. Welcome to June. Equity futures positive on the S&P 500, positive by 0.2%. Big run of gains in the Nasdaq, up for a third straight month, the third consecutive month of gains on the Nasdaq, advancing for a gain of almost 8% last month. This is what Citi's Stuart Kaiser had to say. The tech trade is far less clean than to start the year. We think outperformance is justified and don't see a compelling alternative at this time. That's the problem, Bramo. And I know you've read this note as well because I saw the quote you tweeted out just on where that performance has come from. Just a handful of names.
And the reality is that a lot of people don't see a reason for it to stop unless it's a tactical sell-off like the one we saw yesterday, which is a 5% sell-off for NVIDIA, but it doesn't really matter considering they've been up.
There's an alternative in the bond market, but within the equity market, there is no alternative still.
It seems like that's the case, and now it's a safety trade despite what's going on with yields.
Let's talk about treasuries. 2-year, 10-year, 30-year, 2-year through May, up 40 basis points. Trim some of that gain to close out the month. Yields up by a couple of basis points right now to 442.77. Just to kick off a brand new month with yields a little bit higher on the 10-year too, up a single basis point at 365.79. Just want to touch base with the euro just briefly. Had a look at 107 again today, 107.10. President Lagarde talking up more rate hikes, all of the above. But we are coming back off the back of the worst month for the single currency, for the euro, going all the way back to April, Tom, last year.
Lots going on here. We don't need to do EM right now, but yeah, I agree, John, with the euro focus is really driving everything. I look at euro yen. It really hasn't broken through strong yen either way. Both of them are pretty fragile against the dollar.
You mentioned crude, 67 handle on WTI.
It's there.
Down by about 36 cents there, so it's a break of 68, down about 0.5%. We've got an OPEC Plus
meeting.
meeting.
To 100?
I do remember that, yeah.
100 pages
Tom, based on how this year's gone so far, who knows where we're going this year? Crude. Don't we always say, if you want to make a fall out of someone in the market, ask for a forecast on oil?
Somebody came up to me in the street yesterday, I think it was Fifth Avenue, I can't remember, and they said, when did Bramo sell the barrels in her living room? And I said, I think it was like 95. She didn't top ticket. But she just, unloaded those 2 barrels out.
In and around 130 last spring, remember?
Yeah.
When that war really kicked off in Ukraine. Still ongoing. And I mentioned this earlier, but the team here at Bloomberg, I think summing it up well. On the one hand, you've got inventory shrinking. On the other hand, you've got data that's been weaker, specifically out of China. And that's where these triple-digit crude calls were coming from. Not all of them, but some of them. This idea that China was reopening, you'd get all of this demand coming through Bramo, and crude's not taken off in quite the same way.
It's been a mystery wrapped in an enigma. I will just say that oil has been sort of epicenter of the uncertainty of the economic moment. Also at the epicenter is retailers. I wanted to take a look at what we saw out of Macys and Dollar General earlier this morning. Macys, we talked about the disappointment. Let's just experience the earnings per share expectation for the full year. They now see it being $2.70 to $3.20. Previously, they saw as much as $4.11. So a significant downward revision to their earnings. They talk about inventory. They talk about the weaker economic situation. And yet we still see people buying airline tickets. We still see people eating out and borrowing more on their credit cards.
I mean, they nailed in the control room with the margin study, Lisa. The margins are fine. The issue here is volume and pricing. I don't know pricing unit, but it seems like a unit demand issue.
Yeah, that basically net sales. They were downgrading that at a time when they also were trying to roll off some of their inventory. Dollar General also cited weaker than expected macroeconomic issues, which I think is interesting, saying that people are spending less. How much is this, to Tom's point earlier, bifurcated retailer in terms of who the audience is? But then on Nordstrom's side, they actually delivered better than expected earnings. Those shares are up 3.6%. Talked about some optimism, particularly with off-rack. So basically their off-price rack stores doing better than previously. Their previous track record shows those shares up 3.6%. All of these retailers, though, John, are talking about a weaker than expected macroeconomic backdrop, a weakening one, where people are being more selective with their discretionary spending. So is this an issue of which company is able to manage that better versus really challenging, versus challenging whether the macroeconomic backdrop truly is weakening?
They always talk about the macroeconomic backdrop when things are bad. And when things are good, you never really hear about it. It's just execution, execution, execution. If you've ended up with excess inventory and you need to do significant markdowns, it's probably because the ordering wasn't too good. And that's going to differ at different places. And we saw a lot of that coming out of the pandemic because they were trying to make sure they had the right amount of inventory for the right demand backdrop, and things shifted really, really quickly.
It was confusing. Everyone's sat around in sweatpants for 2 years, and then all of a sudden they wanted to get back to work and wanted to dress up, and all of a sudden they went and you couldn't find dress pants anywhere because everybody was like, oh my goodness.
So they ordered tons.
Exactly.
And then it arrived and everyone went on vacation.
And then everyone went back to Lululemon, which is why I'm interested to hear what we get after the bell today.
Lulu later. Lisa likes Lulu. She'd just like everybody to know.
It's like the fifth time she
like
brought it up today.
Said that today.
No,
is it like the next NVIDIA?
Is this a sponsorship
No,
deal?
no.
Is the surveillance newsletter sponsored by Lulu?
Just in general, whether it's Athleta, pick your brand, whatever you want.
Okay.
It's just that it's going in and out of style, sort of.
Is it in now? Is Lululemon in now?
Style Master. Q.
I'm just
go. Ready. Go.
It's the sarcasm dripping
No.
off it.
It's Lulu in style.
There are some potential competitors at this point. Like Buari is another one that's coming out. It's another athletic brand.
Cutting edge. I'm not up to date at
all.
all.
No kidding. I know. But you have a different kind of stealth wealth.
Stealth wealth. Stealth wealth. This conversation's going places, Tom.
Saving us is Deborah Cunningham, Global Liquidity Markets CIO at Federated Hermes. And if you're in Global Wall Street, stop what you're doing, because this is the conversation for June, July, and it is those pesky money market funds versus deposits. Deborah Cunningham is expert on this. And back to Bruce Bent and the Reserve Fund of the early 1970s, Federated and Vanguard, among others, owned the high ground on developing the concept. Deborah, first question, easy. Are money market funds safe given the debt crisis and the gyrations we're going to see in full faith and credit short paper?
Before we start that, though, Tom, let me just tell you, I'm wearing no Lululemon, but maybe a little Nordstrom's. And I do like some of the retailers that are out there. More the services side, though, than the good side. Safety and soundness from a money market funds standpoint, it's there. Diversification is high,
Right.
short-term, high-quality securities, very short weighted average maturities. You're talking days and weeks, not months and years. You're talking about high liquidity, and the securities that are being purchased, oftentimes collateralized, if you're talking about repo or asset-backed securities. Or the government with treasuries and agencies.
What is a basis point pickup on yield? Back in the early 70s, this was sacrilegious. It was un-American. Everybody was going to die, and Federated had the courage to persist through this with others like Reserve Fund, et cetera. What's a basis point pickup, and do you think it will continue to boom?
Right now, all of our products basically are yielding over 5%. So that's a pretty substantial pickup. When you look at, some banks that were trying to keep deposits, they were maybe paying 3.5%, 3.75%. Whereas those who were necessarily not all that excited about keeping deposits were still in 0, 1, and 1 handles. So there's a substantial pickup when you go from deposits, uninsured deposits specifically, into money market funds where you've got market rates, and those market rates are 5+% right now.
How far along are we, Deborah, in that transition from deposit accounts that pay you nothing into money market accounts that pay you 5%? Because we hear about the greatest outflow of bank deposits going back for 40 years.
Well, it started when interest rates got off of 0, and that happened obviously over a year ago now, Lisa. But I don't think it's picked up the speed in earnest that it will likely have when a peak in rates is reached and when actually rates start declining, which we think won't happen until 2024. Wow. Generally speaking, when you look at where money market funds gather the most amount of assets versus deposits, it's in a flat to declining rate environment, not in a rising rate environment. I think what made it a little bit different in the current rising rate environment is that we came off 0, and 0 was held by the banks while it wasn't held, obviously, by market rates, and that made a difference.
As you speak, I just hear that sound. It's the sucking of liquidity out of the market. At a certain point, if you get an acceleration of these deposits, it could have a pretty material effect on the broader economy. I'm just wondering, can we say we're about halfway through of the deposit flight? Can we say that it's going to be even significant, more significant than people have expected? Or do you think that it's going to be this sort of gradual tick, tick, tick until the Fed starts cutting the rates more significantly?
Gradual tick, tick, tick. I don't think anything happens, overnight, because generally speaking, these are retail accounts. And retail usually is a little bit stickier, usually takes a little bit more time for decision-making processes to occur. So I don't think it's something that is, sort of a flight syndrome that occurs and destabilizes. I think it's something that ultimately is gradual and to a large degree just kind of assimilated into what's happening from an economic and an issuance standpoint. I mean, right now, if money market funds continue to gather cash with the amount of treasury bills that are expected to be issued in the marketplace to bring, cash coffers back up to the $500 billion trillion level, we want a lot of availability for purchasing those bills and cash flow into government money market funds certainly will aid in that process.
Interesting. You wonder if that disrupts the banks. Once again, Deborah Cunningham, Federated Hermes. Deborah, thank you. Wonderful to hear your contribution. Amazing how divided things are. Tom, you and I and Lisa have tried to talk about this a fair bit. The cash trap, the reinvestment risk down the road. Bob Michael of JP Morgan Asset Management sitting in that seat yesterday talking about the risk associated with cash. So let's talk about that risk. You sit in cash, you get 5%, great. You sit in a 3-month T-bill, whatever. 3 months is up, okay. You get the money back. The money you get back is bigger. That's your yield, wonderful. And then what do? You think about reinvesting it. You buy another 3-month T-bill. Okay, keep doing that, 5%, okay. And then at some point you face a rate cutting cycle and you face the risk of not having that 5% there anymore. And what the likes of Bob Michael, and it's very divided at the moment, what the likes of Bob Michael are saying, sweet spot 5-year. Lock in rates, Tom, for, let's say, 5 years, take the belly of the curve, and that's what he thinks the sweet spot is. And Tom, on top of that, not just the yield, but something you've talked about, the total return of that as well. Return. If you do get that rate cutting cycle and rates come in.
The legend and my great affection for Dan Fuss of Loomis Sales, it's all about total return. And Mr. Michael, who's a grizzled veteran back to Scudder and Schroeder's, I should say, and Bankers Trust, you clip the coupon and he's adamant you will see a gain on top of the coupon, which begins to get back those bond losses of the last couple of years.
I'm just curious about whether inflation's going back down. If it's not, that's a different story. And that's where the bifurcation comes in.
There's a huge, huge debate around this at the moment. And TK, as you and I have said a million times over the years, getting into cash is one decision. Getting back out of cash is a much harder decision.
Wildly asymmetric.
Especially when you see these moves in the NASDAQ. It's like, should we go?
You're feeling
should
it right
we go?
now.
Chuck Grommer, Gordon Haskett on Macys earnings coming up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. NATO foreign ministers will discuss Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. Meanwhile, Ukrainian President Volodymyr Zelensky made an unexpected appearance at a summit in neighboring Moldova. The summit is taking place less than a dozen miles away from the breakaway region of Transnistria, which hosts Russian troops on Moldova's eastern border with Ukraine. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a coalition of patriots. Former European Central Bank President Jean-Claude Trichet says despite an environment of great pessimism, Europe's boldest endeavor was the creation of the bank. He spoke to Bloomberg's on the ECB's 25th anniversary.
We also proved something which is very important, I would say, historical trend. We started with 11 countries, we are now 20 countries. In my 8 years of mandate, I welcomed 5 new countries, you see. So there is something underlying, which is very strong.
Meanwhile, Vice President Luis de Guindos says the ECB is in the final stretch of hiking interest rates, with further decisions to be data-driven. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The U.S. consumer has been strong. I do think, however, that the direction of travel for the second half of the year is one where a ton of headwinds are gathering momentum. So the U.S. economy is going to slow as well, and we're already seeing signs that the labor market is starting to cool down.
Seeing signs that the consumers start to cool down. Looking at Macys this morning, that was Barina Urici there, the US economist at T. Rowe Price. Here's Macys right now, negative in the pre-market, with a pretty dreadful full-year outlook relative to what they told us last time around. We're down by close to 9%. They're talking about a weaker consumer this morning, Tom. Don't see that really in the airlines. Don't see that in the labour market, do you? You don't see it at some other retailers as well. TK, so what did you call this, Bramo? A mystery wrapped in an enigma?
An enigma. Surveillance.
Is that Macys right now?
It's everything. No, yeah, it's definitely, it's the retail sector. It's the economic data in general. It's choose your own adventure.
It's true. I agree with you. Manufacturing PMIs, ugly. Services PMIs, decent. Michael Purvis this morning at Toolback and writing about that again this morning.
Out front on this is buy, hold, sell, and it's real simple. The hold means I'm not that enthused. Chuck Grom, senior retail analyst at Gordon Haskett, love having him on, and it is about the parsing here of a hold to a buy. Chuck, real simple. With this disastrous set of headlines from Macys, you nailed it with a tepid hold. Does Macys become a sell?
I think Macys is still doing a really good job on a lot of fronts, and I think that's exemplified on the balance sheet where inventory levels are still really lean. Macys is a victim of the circumstance right now, and you alluded to it. People are preferring travel, and with inflationary pressures out there, budgets are constrained. So I don't personally think Macys is a sell. We downgraded the stock back in late March at $18 to a hold. We sensed that the guide for the year that they outlined was too optimistic, and today we're seeing that to a degree. But Macys is still doing a lot of good things.
Okay, they're doing a lot of good things, but the fact is it's been a train wreck for 10 years. And then in the pandemic, it sort of came around, and I get that's come off the bottom a little bit. Do you have enough faith in management and their strategy to say I got a 3 or 5 year vector higher in Macys, even if it's not back to 60 or 70?
I think that's all going to depend on the consumer and what happens over the next couple of years. In the near term, we definitely think the stock is going to stay under pressure. They did lower guidance by 25% this morning, which is a really big cut. Clearly, the stock had been under some pressure, and this was discounted to a degree. However, when you really unpack the guide, the fourth quarter, which is the holiday quarter for them, still does look aggressive. So, said differently, this might not be the last cut on guidance right now. We're just going to have to continue to monitor the data points across retail.
Chuck, you were brilliant last time we spoke. You said this was the discretionary recession. And Chuck, I think what we're all trying to work out around the table is what is this about Macys and what is it about the economy? Which one is which? Is this a Macys story or a story about the economy?
Yeah, well, what's interesting is this morning you have two companies guiding down, both Macys and Dollar General. And if you think about the Dollar General customer, it's at the low end. Macys is clearly at the high end. So you're seeing weakness across the board, whether it be low end, high end, discretionary. And we talked about that a couple of weeks ago when I was on post Home Depot. It's really just people preferring needs versus wants at this point in time.
Chuck, you said that Macys caters to high end, and yet the luxury players are all seeing gains. Is that really the case, or is it really a question of identity? Whether they actually are high end, whether they're low end, whether basically they're the middle income kinds of shoppers that are probably going to be the most squeezed right now?
Well, I look at Macys more high end, but clearly if you were to look at Nordstrom or even the Bloomingdale's banner within Macys, that would be high tiered. But you look at a company like Restoration Hardware, which is really the most premier upper end company we cover, and you're seeing weakness there. So consumers just getting strapped right now.
Do you think that this is a temporary phenomenon as people sort of get the YOLO experience out of their belts and basically just keep flying around until they run out of money and then they'll go back to buying stuff again?
I do, actually. I do think that there'll be a time, and I'm not an expert in travel and leisure spend, but clearly people are over splurging right now, given that you weren't able to do that for a couple-year period. So I do think at some point you'll see some balancing here across the board.
Could you talk about the difficulty of ordering the correct mix of clothing at a time that still is the pandemic economy, as we've been talking about pretty much over the past couple of months? How difficult it is to know whether people are going to want stuff to go back to the office, stuff to go work out in, stuff to go out on the town, or the casual back? I mean, how do you sort of parse out this quickly moving trend cycle?
it's not easy, and I'm glad that's not my job. But I do think that Macys has done a pretty good job over the past couple of years, knowing where the trend's going to be. But that's one of the reasons why people like off price, because the lead times on off price are just so much shorter in duration. You're talking about buying stuff today for the next couple of months, as opposed to buying stuff today for next spring. Knowing what's going to be hot and what's not, 8 to 9 months out is really, really difficult. And that's part of the reason why, these department stores have just struggled over the past decade and have really given up a lot of share to off price.
Are department stores dead?
I don't think they're dead. I think certain models are better than others. And I think, again, I'm not here to be super negative on Macys this morning, because I do think that the team, and particularly their CFO, Adrian, has done a really good job managing inventory levels. Others, I think, companies like Kohl's have struggles, and getting foot traffic into those stores has been elusive for a really long time. And frankly, I don't know how they fix it.
I just find this absolutely important. And on a revenue and unit basis, this is just a lack of traffic into the stores. So what's your single best buy within retailing now? Is it a combined department store feel, or is it a specialty stock?
I think the best two names to own right now in retail are Walmart and Costco. And you'll tell me that's super defensive and potentially super boring, but sometimes boring can be good.
Interesting.
Costco is the best retailer I've ever covered. It checks all the boxes. And to me, Walmart, there's no better time to own Walmart than right now, both from a sector perspective and given how difficult everything is out there, and also from a company specific perspective. They're doing a lot of really good things. And I think the key theme for both companies is they lead with price. They're the lowest price guys out there. And what consumer out there doesn't want lower prices right now?
If you believe we're in a discretionary recession, quite clearly, that's the place to be. Chuck, thank you, sir. Chuck Grom there of Gordon Haskett on the latest with some of the retailers. When was the last time we went to a Macys, TK?
Long time ago.
Years and years. Haven't been for a long time.
They own other things as well, but I'm just looking at. I don't have a banner to bring up here. I'm sorry for that on TV, but John, it's simple. Costco, 10-year track record, 19% per year.
Sounds terrible.
Macy's, -8% per year.
There you go.
Do the math. 19.8. That's 2,700 basis points delta between Chuck Grom's Costco and Macy's.
This is the thing. Nordstrom and some of the others have really made the experience of a department store something specific and modern. And that's sort of the question with Macy's. What are they going to do with that? I mean, I do wonder, are they going to be sort of the closet where you can go try on stuff and then order it online? Or are they going to be something where you go and you buy it on the spot? I mean, it's a different story to sell than the Nordstrom that was saying, okay, we're going to make this whole experience, get a manicure. They push back a little.
My scientific analysis is simple.
Get a
Third
manicure.
Avenue.
I don't know.
John, I don't know what
manicures.
Oh my God. No,
right.
I'm just saying, like, their services.
Inquiring minds want to know.
I'm sure they
Third Avenue gets more and more jammed with trucks with boxes on them. That's all I know. It gets worse and worse every
Third Avenue. We should draw a distinction between Midtown East and Midtown West, because we had a guest on yesterday who was talking about where they worked. And where they work was Midtown West, and there's a lot of banks up there, up 6th Avenue, up and down 6th Avenue. You can see them there. That's kind of busy. New restaurants opening up over there. Midtown East, dead zone. All the way down from like 50th down towards Grand Central. It's a bunch of hotels that went into the pandemic, never reopened coming out of it.
How much of it Hudson Yards basically eating the lunch
Sucking it
of
away?
Midtown East? I mean, because it basically was Wall Street moved to Midtown East, now moved to Hudson Yards. Is this basically what we're seeing at a time when overall the pool is shrinking and isn't going to come back? And what does that do to commercial real estate?
I would lean on the tech employment in New York. Cranes had a wonderful article yesterday on some document that Facebook had to put in showing their employment dynamic in the city. I think
Interesting.
we way underplay the summed tech employees, and John, they're way over on the west side as a general rule.
Don't they all want to work from home too, Tom?
Yes.
Tech employees.
Amazon was protesting. They walked out saying, we need to work from home.
Work from home protest?
Yeah.
What did they walk out from?
That.
The office or home?
Well, they're being mandated to go 3 days a week, and they were not happy.
I protest. I'm going to do 4-day weeks.
Investors are seeing cracks forming, and they're trying to get out of the way.
We are headed towards slower growth. I think you're seeing that in Europe now. You're seeing that in China.
China's not in good shape right now, and I think we are looking around and seeing what is going to pull China out of the doldrums.
The economic data, not great across the globe, but it's actually better in the U.S. right now.
The U.S. will not be as strong in the second half of the year as it was in the first half.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Cancel the Thanksgiving parade. Macys challenged, troubled, down 9%. Really can't get a bid right now. It's going to be an interesting conference call on what they do the fourth Thursday of November.
We've got some questions, haven't we? Is this a story about Macys, or is it a story about the U.S. economy going into payrolls tomorrow? The estimate in our survey is 195,000. Unemployment potentially climbing from 3.4% to 3.5%. Clearly things are bad at Macys, Tom. Are they that bad for the consumer?
It's a roll-up. I mean, I'm talking about zombie roll-up here. March 2005, John. Bon Macys, Burdeen's, Goldsmiths, Lazarus, Rich's. Macys is a agglomeration of middle America. And is it a middle America in recession, even though the fancy people are doing well? Maybe that's the metaphor this morning.
You raised the question, Tom, with Chuck Grom of Gordon Haskett. Is the department store dead?
Yeah.
Is it dying? Yes. Is it dead?
It's a loaded question, and I think it depends on what level of store it is, the perception within the public. I mean, I'm not an expert on it, but there seemed to be a lot of traffic in selected specialty stores in the upper scale area versus really some serious damage at Macys. I mean, if you're just joining us, folks, these Macy headline numbers, I'm not going to go into them now, but there's some significant line-by-line damage there.
Well, if you are just joining us, I'll share them with you. The full-year outlook for adjusted EPS, 270 to 320. They had seen previously 367 to 411. So the low end of the range last time around, not even the high end of the range this time around.
Nice. Yeah.
And that's when you know you've got a problem, Tom.
You got a problem there. You wonder how it folds into Jobs Day. We've got claims coming up here in 28 minutes. Early Jobs Day this month. On to June, ISM Day. What do we see from ISM? John, you hang on ISM at 10 o'clock.
Look,
what's
manufacturing in recession. Gordon Haskett, Chuck Grom there said discretionary recession. OK, well, manufacturing's in recession as well. Based on the PMIs, which are deeply contractionary in Europe, in China, and Lisa, in the US as well.
And this is why it's been so confusing, because if you look at those recession, if you look at the guidance from Dollar General, from Macys, looking pretty negative. And then you look at American Airlines, you look at Southwest even coming out and actually increasing some of their forecasts, according to reporting by Reuters. You could see people are still traveling around, still eating out, and you do see the economy propped up. How do you pair, Tom, the idea that Challenger Gray and Christmas Inc., this job sort of view that comes out, are seeing planned layoffs quadrupling this year, and pair that with a 3.5, 3.4% unemployment rate? I
used to hang on Challenger Gray, and I don't anymore. Michael McKee taught me to do that. But with that said, the job numbers are important. And, John, the survey is under 200,000. It's dipped down to a 195. It's not a big difference, but it's directional sort of into tomorrow's report.
There's multiple ways of looking at the same thing. There always are. But 200K with unemployment at 3.4. Still a pretty decent read, isn't it?
Yes. It's better than pretty.
If I said take a guess, and I often reflect on this Jackson Hole speech from Chairman Powell, we did that a little bit earlier, but if I said take a guess back in August of last year when he was talking about jacking up rates, Bramo, and causing pain, if we'd guessed that going into the summer of 2023, unemployment would be at around 3.5%, I think a lot of people would have laughed.
And a lot of people would have said, you need to actually see the pain that he's talking about. And right now what you're seeing is the exact opposite on the Fed, and actually saying, look, the pain is going to come. You'll believe it when you see it. We're going to just take a step back, figure out what the damage is, and not go further.
It's a process. It's happening slowly, Tom.
There's a process in Washington as well. 30 seconds here, debt ceiling. What are we watching today?
Through the House. Needed the Democrats on board. Onto the Senate. Hopefully get a vote and pass this thing going into the weekend.
Anne-Marie Hurd, another ruined weekend. I mean, there's no question.
Potentially, potentially.
No question about it. I don't know, red and green on the screen. What can I say about the NASDAQ? 14,310. Sell in May and go away. NASDAQ, John, up 8% through May.
Strip out the muscle of big tech, Tom, and the equity market not doing much. Just monster outperformance, relative outperformance from the NASDAQ versus the S&P. S&P barely squeezed out a month of gains on the S&P 500 through May. The NASDAQ up by something like 8%.
Wall Street Journal, surveillance workers to be allowed to work remotely 2 days a week.
I like
Officials say. New York City workers.
New York City workers.
Yeah, I don't think that's us.
Okay.
There's a headline as well.
2 days a week, that's kind.
Yeah, it's kind. Yeah. Victoria.
Interesting that the mayor at the same time, Tom, is trying to say everyone needs to get back to work in the city.
But this was, and just the backstory here is, they said everyone needs to get back to work, and people said, okay, I quit, and they couldn't hire enough people. And there was this huge backlash. So this is sort of the concession at a time where they want everyone to get back to the office, but still need to be fully staffed.
I can't cite it, but somebody had a brilliant long piece on childcare in the last 24 hours.
It's a massive issue.
The charts are frightening. I mean, this is a huge, huge issue. We don't have time for that right now. Victoria Fernandez is with us, Chief Market Strategist at Crossmark Global Investments. I love the back end of your essay, Victoria, where you talk about the fight is to have your clients in private wealth management not throw in the towel.
Yeah, I mean, look, you're talking about all the different elements that are going on in the market right now. And a lot of it, even though we've said this for the last year, a lot of it is really fighting against each other. You have this one element of the market, the tech, the AI-related tech names that are really strong. You guys were just referencing the difference between the NASDAQ. You compare that to the S&P, the cap-weighted S&P, and then to the equal-weighted S&P. You're at one of the widest margins that we have ever seen. So at some point, those have to come back together. We don't want to sit on the sidelines and have just a very narrow breadth in our portfolios like we're seeing in the market. We want to have some of that diversification. So no, don't throw in the towel, but go in and find elements that you think can still do well in a volatile market and a economy that we think is going to be slowing at the end of this year, but still supported somewhat by a consumer, with manufacturing coming down, but savings rate and discretionary income still holding strong. So there are elements you can work with, but you have to be choosy.
What did we learn in the first 6 months of 2023?
That's a loaded question there, Lisa. I think we learned that we can't say everything is like it always has been. Things have happened very differently. You have a bond market and an equity market that are not reacting to each other the way they have historically. You have us going to the brink again on a debt ceiling. That probably is things like we've seen before, but pushing it to the limits and causing the market to react the way it has, pushing up short-term yields to 5.25%, 5.5%, driving people into the short-term treasury market, out of the equity market. These are all things that have been very different this year because we walked into an economy in a different manner with the pandemic than we had before, supporting a consumer. So I think we've learned that you have to be cautious. I think we've learned that you have to be tactical in this market, but I also think we've learned that you don't want to try to jump in and out all the time. Use your fundamental analysis to build strong portfolios.
Where do you fall on this debate, which is a really pretty bifurcated debate, on whether inflation is going to rapidly decelerate heading into the end of the year or whether it's sticky? I mean, this really has been the core disagreement among the JP Morgans of the world and the BlackRocks of the world. Where do you fit in this?
I'm more leaning towards we're going to have some stickier inflation. Not that we're not in a downward trajectory. We can be on that headline number, although we've seen core CPI numbers actually hold steady or move up a little bit over the last few months. So I think you've got that sticky component, and it's not just going to be housing. Although you look at Zillow rents, those are up over the last month. Housing is rebounding. We heard Michelle Bowman saying the rise in housing costs is actually working against what they're trying to do on inflation. So I think we're going to have a stickier number. It's going to come down slowly, and I'm not sure that's going to be enough for the Fed, which is why I can't say there's a zero probability that you get more Fed rate hikes in the future.
Tell me about 60-40 right now. I mean, I've been looking at the numbers over the last number of weeks, sort of like, halfway through the year, beginning to chew on it, and I just don't get it. Are you overweight equities or do you hide out in bonds?
Well, yeah, the 60-40 was always kind of the go-to for everyone, and I think you have to be a little more tactical than that right now. Going back to some of the elements we talked about, Tom, the breadth in the market being so narrow, it's hard to have a 60% allocation and have that outperform without having high concentration in those names, which is not something we want to do. So yes, we think you should be adding to some of your bond allocations. We had a client call us last week and say, here's another $2 million, and we wanted his cash alternatives all in short-term treasuries to take advantage of those yields. You have to be careful with reinvestment risk when you do that, when you put all your eggs in that basket. But along the curve. Put a little heavyweight on the short end, add some on the longer end to lock in yield for longer. And that gives you a little bit of buffer against equity market volatility that we think we're going to see as a mild recession comes into play later this year.
If you've got a spare $2 million, 1-800-Fernandez TK. Just make it happen. I've got a spare $2 million. Want to throw that at some T-bills. That's the life, isn't it, Bramo?
Yeah.
Playing golf.
Yeah.
Money market fund.
You know.
How many people?
You know.
Just complete the front nine. Just got some $2 million. Just throw it at some T-bills.
Is that what you do at night?
Yeah. Every
Try
night.
to figure it out.
Call Victoria and ask for $2 million worth of T-bills.
I run in money right now. I'll tell you, it's brutal. It's brutal. There's no other way.
It's pretty fun though, Tom. Relative
It's
to how
fun, but
boring it's been at times.
Okay, but if you're not in 12 selected winning theories or guesses or whatever,
agreed.
No fun.
Well, this is the year that macro trading has kind of died. And other people might disagree, but it's been really hard to get any of those calls right. But if you look at the micro trades and the specific names, stock selection, I keep hearing that. And you are seeing different stories kind of pop up. Getting them right's another story. But I mean, maybe that's a lot more fun than it has been when the Fed's just like, we're going to tell you to buy. And everyone goes out and buys. Or they say, we're going to tell you to sell. Actually, that never happened.
Having a great time in foreign exchange. Just having a great time.
But what are you tracking? I mean, honestly,
it's just beating up consensus positions.
That's what you
and
do.
loving it. Oh yeah. This counter trend move in the euro in the last month. That's
the
that's
dollar
what you're doing with your $2 million.
John, we got Steve Englander in 30 minutes.
to go from close to 111 and have a sniff of 105, 106, just like that. Fading data out of China. Got the itch, Bramo. Futures on the S&P positive by 0.1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. Meanwhile, Ukrainian President Volodymyr Zelensky made an unexpected appearance at a summit in neighboring Moldova. The summit is taking place less than a dozen miles away from the breakaway region of Transnistria, which holds Russian troops on Moldova's eastern border with Ukraine. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a coalition of patriots. NATO foreign ministers are discussing Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. France and Germany are split over Ukraine's NATO appeal. France is pushing for a concrete path for Ukraine to join the NATO military alliance, but Germany is urging more caution about discussing membership in light of Russia's ongoing war. The U.S. House has passed the debt limit deal struck by Speaker Kevin McCarthy and President Joe Biden to avoid a catastrophic U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday night.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the president's desk as soon as possible.
Mitch McConnell says a Senate vote may happen as soon as today. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase.
The state of Fed speak right now. Philadelphia Fed President Patrick Harker there. I don't like the word pause, but we can skip an increase. I don't necessarily think it's their fault. I think actually it's the market and market participants who believe a pause is ultimately the next step towards cutting. And that's something the Federal Reserve doesn't want to communicate because we had all these cuts priced in the back half of this year, which they wanted to lean against. And get this market to price out.
I'm just saying, if I had said that, you would say you're getting soft. You're not saying it's their fault.
I've said that before.
But they're in a difficult situation.
I don't have sympathy for them.
Oh my goodness. What is the difference? I mean, honestly, they're in a tricky spot with a market that is going to respond in a way that's counterproductive and an economy that's really uncertain.
They're in a tricky spot.
Yes,
I just don't have sympathy for them. All right, for many reasons, and we can talk about those reasons later. We've got some data. Look at that. Mike Macys here. Hello, Mike.
Hello, guys.
Nice to you.
And this is data that is going to lean against Philip Jefferson and Patrick Harker yesterday. ADP comes in at 278,000 jobs for the month of May. That is significantly higher than the 170 that analysts had expected. The April number revised down to 291,000 from 296, but that's neither here nor there. And we don't really look at ADP as a predictor for the jobs report on Friday, but in this case, they have been coming in lower for the most part than the non-farm payrolls number. So this is something to keep an eye on here. We're wondering how strong the economy is.
Jobless claims coming out in about 14 minutes. Don't you just feel sorry for them? Right now at the Federal Reserve.
Oh, come on.
Yields up 4 or 5 basis points, the 2-year, 4.45. Mike, just quickly, how should we read claims in 14 minutes? All these, I don't want to call them distortions, but disruptions to the data over the last few months. What's the read on this later?
Yeah, I think basically what you have to do is sort of look at the trend as opposed to the number, because the numbers have bounced around, part of it fraud. And we should be seeing a rise in claims if the economy and the labor market are slowing down. And we can't really say that we have seen that yet. So if we get the same kind of numbers that we've been getting, it looks like the labor market is going to be really strong still going into the Fed meeting on June 14th.
Mike, thank you, mate. Claims, Tom, about 13 minutes away.
It's going to be huge. It's weekly data. I take a 4-week moving average, try to smooth it out a little bit. But, yeah, the fraud thing hangs over it. It's just more data of what is somewhat a fully employed America. Writing about that has been William Dudley, former New York Fed president, Bloomberg opinion columnist. He has been absolutely 100% on of a central bank looking for higher interest rates. Bill Dudley, thank you for joining us off your essay with Bloomberg Opinion. You quote the Clash, you channel back to London Calling. Guess what? The Eccles building is calling. Do they have to wait for the data, or can they get out front?
Well, they're going to take a pause because they believe that there are long and variable legs of monetary policy, and so they want to see the effects of prior actions. But they've characterized it as a skip because they think that they'll probably have to do a little bit more. And we'll probably see that in the summary of economic projections. We'll probably see a couple, 1 or 2 additional rate hikes penciled in for 2023. The economy really hasn't slowed much at all. If you look at the Atlanta Fed GDP now forecasts for the second quarter, it's 1.9%. And as you were just talking about, the labor market still seems very, very strong. So the Fed hasn't really accomplished much yet.
Bullard of St. Louis and Indiana University uses his economics to say we can do this exercise and avoid some form of NBER recession. Do you agree?
I think it's made very hard to avoid a recession if you believe that the Fed has to push the unemployment rate up by a meaningful amount. If you look at the Fed's own forecast, they think the unemployment rate is going to have to rise by at least 1 percentage point. Every time it's risen by 1 percentage point since World War II, we've had a recession, 12 out of 12. So I'm betting against a soft landing this time as well.
Bill, the implication here that the Fed hasn't really accomplished much and that they should go further with respect to hiking rates, that perhaps a pause or skipping or whatever you want to call it is perhaps not the right approach. What's the consequence to that? Do you expect this to actually accelerate inflation or keep it higher for longer in a way that people aren't really expecting?
It doesn't really matter if they hike in June versus July, as long as they keep financial conditions from easing significantly. And I think that's why they're using the language of skip rather than pause. They don't want the markets to think that they're finished because they don't want the stock market to rally a lot, bond yields to fall. If that were to happen, that would make monetary policy, the impulse of monetary policy, more stimulative and would be counterproductive to what they're trying to accomplish, which is to cool off the labor market.
The data's been really confusing. We've been talking about that all day, whether it's earnings or whether it's just the macroeconomic inputs that we normally have used. What are you looking at to really highlight that there's still a lot of strength that, frankly, the lag effects are not going to take care of?
Well, I think the labor market is the key thing to focus on. What's happening to payroll employment growth? What's happening to the tightness of the labor market? As, for example, the JOLTS report yesterday showed an increase in the number of unfilled jobs relative to unemployed workers. We're back to 1.8 unfilled jobs for every unemployed worker. Chair Powell in the past has said we need that ratio to be down around 1 to 1. And also what's happening to wages. Powell in his last press conference was very clear. He thinks wage inflation needs to be 3%, not 4 to 6%, to be consistent with 2% inflation. So the labor market and wages, I think, are going to be the key drivers of the Fed feeling more comfortable that they're actually on a track to 2% inflation.
Some people will say, well, we are seeing disinflation, and it actually will happen much more rapidly heading into year end. From your vantage point, the longer that it takes, does that create a stickiness that people are underappreciating? Or do you think that this is just simply they need to get back down to their goal? They want to get there sooner than later, just simply to remove that tax from lower income individuals in particular?
They think it's going to be a pretty drawn-out process. We really don't get back to 2% inflation for a couple of years on the Fed's own forecast. I think they're not concerned about how long it takes, as long as inflation expectations stay well anchored. The risk, of course, if inflation stays higher for longer, inflation expectations could become unanchored, and that would make the Fed's job more difficult. So they want to keep a close eye on inflation expectations.
Bill, we're not thinking too hard today. I don't need it to 2 or 3 decimal points, but I'm fascinated what your math is on a slower China and their machinations exporting disinflation or outright deflation. You and I have seen this over 30, 40 years as a theme. Are they going to adjust our lives because they're exporting price decline?
I think what's going to happen in China is we're going to see more stimulus. End of the day, that they're going to want to have growth because growth generates jobs, and jobs generate political stability in China. So I think what we'll see is more stimulus out of China. I do not expect the Chinese impulse back to the U.S. to be significant. We already are having goods disinflation. The problem in the U.S. is really in the services sector. China might add a little bit to that goods disinflation, but I don't think it's meaningful in terms of changing the inflation outlook.
Do you have any kind of vector of disinflation with services at this time, or do you just simply need more data points?
Well, the one thing that we know is coming is we're going to start to see declines in shelter prices as measured in the personal consumption expenditure deflator. We know that was going to happen with a lag, and that lag is about to arrive. The problem is, Chair Powell has indicated, is services inflation, excluding shelter. That's still very, very high. And as we've seen in the core PCE deflators that we've gotten over the last 6 months, we're stuck in this channel between 4.6% and 4.8% on a year-over-year basis. It's not falling. It's basically been flat.
I think that's called sticky, John. I think Dr. Dudley there identified the range-bound necessariness of the word sticky.
I've got some good news for some people. I'm not sure what your positioning is like at home, but for those of you long European vacations, the euro, another break of 107, 106.
You're looking at that to 5 digits, aren't you?
Yeah, for many reasons. The dollar stronger, the euro weaker, off the back of this pretty robust data in America. Yields higher by, let's call it 3 basis points at the front end, 444. Equities, Lisa, just rolling over, just briefly, now unchanged on the session.
Which might come partly on the ADP report that nobody trades until they do, and this idea that if you have a stronger than expected employment reaction, that will actually create more pressure for the Fed. Bill, I want to just finish up with you on that point. Do you think that it is a foregone conclusion that regardless of what the data is, regardless of the jobs report we get tomorrow, they are not going to hike rates this month? They're going to try to signal it doesn't mean that they're done, but basically they are not data dependent for this particular meeting.
Well, I think the data would have to be very, very strong to convince them to move at the June meeting. They basically are concerned about the long lags of monetary policy, and that belief should not be influenced by the strength of the data. So I'd be very surprised at this point, especially given Philip Jefferson's remarks yesterday, that they would actually go ahead and tighten at the June meeting. But July seems, almost likely at this point.
That felt like a rallying cry yesterday, didn't it, from the presumed Fed Vice Chair? It really did. Bill, thank you. Bill Dudley there, former New York Fed president, Bloomberg opinion columnist. Data dependence, the most meaningless phrase in the lexicon of the Federal Reserve.
It just got thrown out. That's what I heard.
It means nothing. It means whatever they want it to mean. And it's always meant whatever they want it to mean. We're data dependent.
Which data? The data next month? The
how
data
much weight are you putting on it?
How much data are you going to have in your input?
I blame Mike McKee for this.
Okay.
I do. Mike McKee, how data dependent are they?
They are data dependent. I'd be a little more hawkish than Bill in terms of the possibility of a June rate move.
Interesting. Why?
If CPI comes in very strong. Now, I think part of what may be going on is that they wanted to knock down this perception that they were locked into a rate increase, because then if they didn't, if the data came, they're not going to be able to tell us what they think of CPI. If the data came in softer, then it would be harder to turn on the market that way. So if they can keep giving themselves some options. This is interesting. I'm watching the Fed funds futures. Remember, we went from 68% yesterday to 38% today. Now we're at 29%, even though we had this strong number.
Kind of de-emphasize the importance, Lisa, to your point, of the incoming information between now and June 14th.
Data dependency no longer for the next month, and then it'll be data dependent.
For the next 2 weeks, and then we're done. Okay, then we're back to normal. All right. In the next hour, Michael Kondopoulos of Richard Bernstein Advisors, Kathy Jones of Charles Schwab, Sam Linton-Brown of BNP Paribas. Those conversations coming up on Bloomberg TV in about 30 minutes from now.
Bloomberg surveillance into claims, and Lisa Abramowicz publishing moments ago, Dana Telsey Advisory Group, seeing, quote, limited visibility on Macys. Not a scathing note, but it is a market perform, tough year ahead note.
Well, and that certainly seems to be what people are readjusting to, those shares lower by about only, at this point, 4%.
You wonder if there'll be claims from Macys as they right size from C to shining C. We will turn to Michael McKee now on the anticipated weekly data. Other stuff as well.
Yeah, other stuff including unit labor costs and non-farm productivity. These are the revisions to the first release for the first quarter, and we see non-farm productivity down 2.1%. It had initially been reported as 2.7% negative, so a slight improvement there. And unit labor costs, this is interesting, initially reported at 6.3%, comes in at 4.2%. So that is a big change, and it will be interesting to go under the hood in these numbers and see why they changed that way. Jobless claims is the number everybody's been following, and we talked about the trend. 232 for the month, for last week rather, and the week prior was revised up to 230. So almost no change in claims. It doesn't look like the labor market is getting any weaker. Now we've had three numbers: the JOLTS numbers, the ADP numbers, and the claims numbers.
And your summary?
Suggest strong. Well, my summary is that if you were a betting person, and we got one more number, the ISM employment number coming out at 10, you would probably be marking up your payrolls estimate. The private payrolls estimate right now is 164, and with ADP coming in at 278, that's more than 100,000 difference. So somebody's going to be really wrong.
I mean, I look at this, Michael, and you know, we're going to have Kathleen Butch-Johnson with us here in a moment, which is wonderful. But have you ever seen it like this, where there's, you know, coming out of a pandemic, coming out of a medical disaster, the Biden stimulus and all the rest, have you ever seen the cacophony sense of it like we're in right now?
Well, we haven't seen it, the Fed cacophony that we have now, the divisions among Fed officials for quite some time. The data are sort of in all different places. So the Fed is in all different places. What's interesting is we tend as economists, and I think as monetary policymakers, to fight the last war. And you think of what was happening after the financial crisis, when everybody kept expecting strength, and it was slow. Right. Now we're expecting slow, because that's what the models are suggesting, and it hadn't happened yet.
Lisa, let me do the last market check. That's a joke there, the last war. Last market check. We're going to continue to do market checks today. 10-year real yield, 1.45%, comes in a little bit. I'm going to call it quiescent, I guess, is the summary of the data. I see a little bit lower yields.
I actually find it more interesting than quiescent, because what you did see was jobless claims coming in lower than expected, right? A downside surprise, although pretty much in line, but showing that it's lower. But that's not what the market's responding to. What the market is responding to is the revision of the unit labor costs coming in. And so yields lower, significantly lower, even though, as Mike said, on the margins, this points to a labor market that would be strong, signifies the bias right now to a Fed on hold, to a Fed that doesn't want to go further, and that seems to be what's getting priced into the market.
Well, and the thing is, this is also first quarter data. So we're now 2 months into the
ancient
second
data.
quarter. So it's old numbers, but still makes the case maybe inflation could come down.
Right, but that seems to be what people are banking on, and whatever the view on whether that's accurate or not, that's where the bias is. What is your view on the incredible revisions, the amount, the degree to which the data was wrong and has to get revised in another direction? Has this ever been seen before?
Well, we always get revisions because the data are incomplete when they're first published, but we are seeing big revisions now, I think, because the various statistical agencies are having trouble with seasonal adjustment coming out of the pandemic. The pandemic messed everything up so much. Just try to graph jobless claims these days, and you get the distortion.
The distortions are still there. I strongly agree with that. We see that. Michael McKee leading our coverage tomorrow at 8:30. We'll go beneath the headline data on an early June jobs report. She's still for that as well. Kathleen Bostjancic joins us now, chief economist, Nationwide Mutual Insurance, with the sum of this strange economy. It's as simple as this, Kathy. We've got retail, witness Macys today, is a statement flat on its back. We've got other parts of the economy doing better than good. Do you aggregate it together, or are you looking at 2 or 3 or 5 Americas?
Oh, good morning, Tom. Yeah, I think you hit the nail on the head there, is that you really have to bifurcate and differentiate among different consumer buckets here. You've got the upper middle income, upper income households, the labor market's strong, earnings strong, equity market's doing well, housing prices holding in there. They've come down a little bit, and still a lot of pent-up demand to spend on services. And let's not forget the savings, right? There's related savings that were accumulated during the pandemic. So that sector's still feeling pretty strong and spending. I think when you get beneath that, that's where you see the impact from inflation and even interest rates. And that portion, like the bottom, certainly the bottom third, maybe the bottom half of consumers feeling the pressure here.
So what does this add up into, Kathy? Does this add up into an economy that's slowing substantially, where the lag effects are going to take hold, or one that people are just missing the forest for the trees here that's a lot stronger than what a lot of people are anticipating?
Yeah, it's been very difficult to call the path of the economy and the timing, but we're still in the camp that it is delayed, the recession, and it's not postponed, delayed, but still coming. We look at the leading economic indicators, and they're still all pointing to recession. And I think the stronger, consumer spending, labor market remains for now, right? Those are coincident indicators. Just more, the Fed's going to be inclined to raise rates. And I think eventually the Fed's going to be successful. They've got to cool down the labor market, cool down consumer spending to cool down inflation. It just may take a little longer than they would like, and maybe the rest of us would like.
Well, you said that they're inclined to raise rates, and yesterday it seemed to be a bit of a different tone from Philip Jefferson, the vice chair of the Federal Reserve, and a number of the others, Patrick Harker among them, basically signaling a willingness to skip this next meeting, call it whatever you want to call it, and not raise rates, wait for the lag effects. I mean, do you think that is the right approach, that basically if they just stay on hold, this is where rates should peak out, and you will see that slowdown that will eventually bring inflation a lot lower?
Yeah, our baseline is that they do pause and hold it there, but I think the risk is, even if they skip the June meeting, that they could come back in July and raise rates. They are assessing things, and I think underneath all of it, even once we get beyond data dependent, I know we can debate whether they truly are data dependent, but what I think it's clear is they still have a tightening bias. Doesn't mean they will necessarily tighten, but they're still inclined to tighten before they certainly cut rates.
Kathy, Augusta Saraiva is publishing on ADP today for Bloomberg News. And our economics team has a huge observation that wage growth is slowing. And here's the operative adverb, substantially. Do you agree with that? I mean, is wage growth really coming down, where even with lower inflation, it's going to be problematic in terms of real wage growth?
We see it more gradual, Tom. Obviously we'll see what the data bring us tomorrow, but all of the signs we're seeing is that the labor market's still pretty tight, and demand for workers, especially certain sectors, really strong, right? We saw that in the JOLTS data So I think it's a gradual process, and same thing with inflation. So it's the pressures are still there for workers. The supply hasn't really come in line with demand at this point. And it'll just take a while for that to play through. And looking at the productivity numbers and particularly unit labor costs, it was interesting. It's old data, Q1, but I guess a nod to the idea that maybe we are seeing wage growth compensation come down. That was a figure that was revised lower.
Columbus, Ohio, unemployment rate 3.40%. How can you talk of cutting rates given that single statistic? I just don't get it.
Well, and this is really the issue, especially if there is 1 or 2 or 16 states where the unemployment rate is a lot higher. And that sort of divergence is something that Bloomberg Intelligence picked up on yesterday, where they were pointing to the idea that 16 states, according to the SOM rule, have already basically entered recession with material increases in their unemployment rates. How does that complicate, Kathy, the whole dynamic when you do have such a bifurcated picture with some people experiencing a recession very much in a tangible way right now?
It's a great point. It is very difficult. The post-COVID economy, it just has skews and differences across sectors and the economy geographically as well. Makes it really difficult for the Federal Reserve. Right? We've had the manufacturing sector, it's in recession. Housing's in recession, although maybe it's bottomed out, but the service sector right now is very buoyant, and that's where all the inflation is, right? So that's one tool, that's what they're stuck with.
Kath, I got to make some news here. Help me out, please. Adjust your non-farm payroll statistic for tomorrow off of ADP and claims. Are you going to lift that statistic up?
Tom, we don't do that. We, in the past, it's not been a great correlation. We are above consensus for what that's worth. We're at 205,000. We could have had a lower number, but I think
there we go.
Economists have been missing on the downside. So we're comfortable with about 200,000. We do think things are slowing, but we're certainly not seeing recession signs in the labor market yet.
So, Lisa, that wasn't we made news, but we made sort of kind of like news, right?
Well, Mike made news, Mike McKee.
Mike
when
McKee
he was
always
basically
makes
saying
news.
that,
Financial TV. Down in flames with Busjancic. Kathy Busjancic, thank you for the non-news at Nationwide Mutual Insurance. Truly one of my favorite people in aggregating the domestic economy. I give her an equivalency with Jim Glassman over at J.P. Morgan. She's just got this great handle on the dynamics of it. And I'm sorry, we have our own bias in New York and the outrageous real estate costs here. It's healthy to go to the internet and just look at the unemployment rate of Wichita or the unemployment rate of Fort Worth. I mean, it's informative.
Well, and here's the issue, and this, I think, is the reason why I was glad that you brought up the wage disinflation that you're seeing, the cost of employment coming in. People haven't given up on the immaculate disinflation story just yet. And that, I think, is really coming clear with some of the data that we're getting today, despite the strength in the labor market.
Wichita, Kansas, a tick lower than Columbus, Ohio, 3.30%. Boy, Bob Michael, yesterday, J.P. Morgan, was he on the disinflation call? If you care about the dollar, stay with us. Stephen Englander, Standard Charter. We do that next. Futures flat. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The House passed debt limit legislation forged by President Joe Biden and Speaker Kevin McCarthy that would impose restraints on government spending through the 2024 election and avert a destabilizing U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday evening.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for.
The measure now goes to the Senate, where approval is virtually certain. Mitch McConnell says a vote may happen as soon as today. Serbia's president called for the removal of new mayors in northern Kosovo. The flare-up started last week as the newly appointed mayors started to take up their posts in northern Kosovo. Tensions escalated on Monday when Serb protesters clashed with Kosovo police and NATO troops, leaving 30 peacekeepers and dozens of protesters injured. Elon Musk's private jet has departed Shanghai, wrapping up his first visit to China since the pandemic that included meetings with senior government officials and a late-night visit to Tesla's Shanghai Gigafactory. In a video released by Tesla's China team, Musk was shown waving to the workers, then thanking them for being at the factory late at night. He also congratulated the staff on their amazing work. And Amazon has agreed to pay just over $30 million to resolve 2 cases brought on by the FTC. Now, in the first case, the agency says the company didn't take enough steps to protect the privacy of users of its Ring video doorbell. The second case involves Amazon's Alexa-powered speakers, which the Justice Department says collected information about children under the age of 13 without their parents' consent. Amazon disagrees with those claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We think that the dollar has probably peaked because the U.S. is probably near the end of its tightening cycle, but we don't think that the Eurozone is near the end of its tightening cycle. And the Japanese markets have been performing fairly well, and they too could see tighter monetary policy as the year progresses.
Tracy McMillan, Wells Fargo, she's talking about a dwindling consumer. We certainly have seen that in Macys today, but this is just out, and Lisa nailed this morning repeatedly. I'm looking at love. I got to get some love here. In the pandemic, I go from 60 down to near 20, and I get a 60 rebound and a big rollover in the share price. Meanwhile, the headlines come out, and there's some love with Southwest today.
So they upgraded some of their forecasts. They expect solid profits in the second quarter and for the full year. And you are seeing a little bit of a lift, up 0.2%. But to me, the big takeaway is people are still going to Southwest, and they still are using this airline despite the debacle over the winter holidays. And that, I think, that rebound is really what has been surprising. They said that demand during Memorial Day weekend was incredibly strong. They see capacity up 14 to 15%, and people continue to fly. And this really flies in the face of exactly what you're saying. People pulling back on buying, say, new shirts and saying, okay, well, we'll fly around the country instead.
Well, it's interesting to see, and we're going to see a lot of other reports on this, I'm sure, moving out here. What you see right now is green and red on the screen. SPX fractionally high. I'm going to call it a fractional Thursday here with the VIX 17.42. Yields are in, and this is off all that economic data. 4.39% in the 2-year yield. I don't have an inversion story, for you this morning of really any merit. I would note the 3-month 10-year spread is challenging at 178 basis points. In oil, we're watching. Lisa, $68.42 a barrel on West Texas. I'm not used to that.
And it's something that Riyadh is very unhappy with, which we found out in terms of their messaging for this weekend's meeting.
Javier Blas was lights out today. Very delicate. Am I correct? We've been banned. Bloomberg and other news organizations have been.
They extend invitations to different specific journalists, and none from Bloomberg, Reuters, or the Wall Street Journal have received invitations to one of the first in-person Vienna meetings that they've had in a while. And this comes as they are very concerned about short sellers, about whatever else is keeping prices lower than they'd like to see.
Stay tuned to Bloomberg News and Bloomberg Opinion for our coverage of hydrocarbons, that led by Will Kennedy. They're really one of our world-class outfits, if you will. We'll have all that coverage even removed from the halls of Vienna. Right now, and this is a joy for Global Wall Street, they will stop at 8:49 a.m. and listen to the number one cross-rate strategist in the world. Bill Winters leans on him. Stephen Engler joins us, global head of G10 FX Research at Standard Chartered. I want you to tell me, Steve, how your Excel spreadsheet adjusts to China slowdown. In the information of cross rates, what does the China slowdown signal?
Well, I think it's an important issue. Both the Chinese slowdown and the slowdown in Europe have removed some of the impetus near term for dollar weakness. The dollar weakness, even though we tend to focus on what the Fed is doing, what the U.S. economy is doing, for there to be broad dollar weakness, we need economic outperformance in the rest of the world. And in some ways, the bigger shock of the last month is how soft the data outside the U.S. has been. Mm-hmm. In addition to the U.S. numbers being ambiguous, I think to get the real dollar weakness, it's not enough for the Fed to pause or for the U.S. data to be soft enough that there's no further hikes. I think you would need to see data in the rest of the world improve.
I want to squeeze this in because Lisa's got 14 questions. I think underplayed in the last 10 days has been Japan. Not only the inflation dynamic, the nominal GDP, real GDP dynamic, but also their creative monetary policy. Is there a tradable move on yen, either massive strong yen or the shock of a weak yen off economic weakness?
Well, it depends on how deep your pockets are. Right? We think that the yen is going to appreciate, and we think that the data in Japan have been improving both on the output side and on the inflation side. Plus the signals from the BOJ and the Japanese officialdom. I think there's more downside than upside. But plenty of people have been burned if you put the trade on too early. There's a lot of risk there, and those ups and downs are pretty serious.
The dollar has been driving a lot of the action globally, and I do want to just go back to that for a minute. We started with Tracy McMillian of Wells Fargo talking about how she sees the dollar peaking. Stephen, you were saying that you likely have seen perhaps a different kind of trend just simply because you have to see outperformance in the rest of the world. Does that mean that you disagree with that idea of a peak dollar?
Well, it depends if you mean dollars of V shape, which I don't think the recent data really support. Dollar kind of not going much higher from here, maybe even slightly lower. I think that's okay. But I think if all that changes is that we're less worried about the Fed and U.S. inflation, I think what you're going to see is a carry trade put on. That's a very specific trade. You cut off the upside tail to U.S. rates. It means all countries that have higher interest rates will look very attractive. That's not a broad dollar downturn. That's a very specific dollar downturn.
Is this a fun environment to be a macro trader?
No, I think certainly in FX, we all want to see trends that we can jump on. We want to see a trend where we don't have to be the first to jump on it, but it extends long enough that we can make money on it, and you just haven't seen.
Well, to translate a fun trade, I think it's a great question from Lisa, but what it amounts to, Stephen Englander, is I need a big figure speculation in EM and Frontier, not only idiosyncratic, but more what I'll call normal. Is there a big figure fun opportunity out there?
I think in the short term, if the numbers keep on coming in suggesting that maybe the Fed is going to be done, I think the Brazils of the world, the Indias of the world, Mexico's gone a long way, Indonesia's, all those currencies that have a lot of carry are going to look very attractive.
Right.
The yen will probably go up a bit, but its rates so far aren't doing anything. We need a signal from Japan. But I think in terms of carry trades, that would be the first stop that the market would go to.
I'm going to go inside baseball here. Does the Indonesian rupiah play off $68 West Texas Intermediate off of $73 Brent? I mean, can you fold in a hydrocarbon guess with a speculation on something like the rupiah?
I don't think it helps, although there are a lot of cross currents in that part of the world. The fact that that part of Asia trades with everybody, and the kind of you're seeing oil going in and out, going in at a cheap price, going out at a high price for some of these countries. It offsets some of the impact of weakness. But I would say, broadly speaking, I would go first with the rates trade, and I think the energy trade is secondary.
Stephen, brilliant. Thank you. Stephen Englander with an update there. Standard Chartered. Did I sound good there? That's like if I talk like that, rupiah and the rest of it, I can pretend I have a red Ferrari and do trades in the city.
Is that what you're trying for?
I have to get a British accent. Farrell would say you can't do it without a British accent, which is accurate.
I'm distracted because I'm looking right now at a story on the terminal saying hiring at U.S. companies tops off forecasts, and another one that planned layoffs has quadrupled so far this year. Take the two of those, put them together, and what do you have? It is a soup. It is an mystery wrapped in an enigma. I mean, this is sort of what we're talking about with this difficulty really understanding which data point to put the emphasis on.
Which means tomorrow at 8:30, we'll bring forward mystery wrapped in an enigma here on surveillance. I mean, to my book of the summer, Olivier Blanchard's wonderful book, and I'll promote it here as we go after Memorial Day. But the basic idea here is Professor Blanchard talks about other factors out there. And the overlay on the time continuum is, there's technology out there and NVIDIA and all that. It's coming off the Biden stimulus. And the immovable thing through his book, 5 chapters, 6 chapters, the immovable thing is there is this thing, which he calls the Biden stimulus, and we're all reacting to it. And that's what we're basically covering each and every moment.
And the amount of money is taking a lot longer to move through the system than many people thought. And I think that is what was sort of the underestimating feature propping up a lot of consumer spending, at least in certain segments. And then we are seeing some softness in other areas.
Oh, we're going to have to see. Now we got futures flat, the VIX 17.43. I'm watching oil 68.26. Has not broken down, but worth watching as well. A timely interview, someone expert on America's debt, our deficit, our fiscal policy. Jason Furman, he's a former chairman of the Council of Economic Advisors, teaches a course up at Harvard every once in a while in the 4 p.m. hour. This is Bloomberg. Good morning.